So welcome to the income tax marathon class. Yes, this income tax marathon I am going to upload in 3 parts. Right now, which you are watching is part 1, where I am covering these 3 chapters. Completely I am covering along with solved sums. Entire, whether it is part 1 or part 2, part 3, all these 3 marathons, even sums also we are solving for few sums which are given in ICA material, test your knowledge questions, which we have even copied in our books also, getting it. So we are covering all those questions now. So in this part 1, which is going to be approximately 5 hours, as you can see this video. So clubbing provision, set off and carry forward, chapter 6A. Remember, all these provisions were discussed in depth, getting it. In the, though it is a revision, we covered it in depth. It is revision means we will discuss it fast, getting it. So we may not do each line by line provision reading, but we will give you the theme of the provision. Now this is part 1, which I am uploading on 15th October 2023, that is today itself. Now the part 2 we will upload on 19th October, capital gains and PGBP with the solved questions. Then day before exam, November 7th, November 8th is your tax exam, right? Maximum by November 6th evening itself, getting it, we will upload these 5 chapters: basic concepts, residential status, total income, return of income, salaries. So that time you can sit along with me and watch the revision. Believe me, you will be mesmerized after listening to this tax marathon. Just this part 1 itself is one proof for you, so you will understand how clear and dynamic this marathon is going to be, getting it. Anyhow, below the description we have given timestamps also for these 3 chapters, getting it. So please make use of this marathon, and immediately after this marathon, please read once, you revise once thoroughly in your book. So that's how you need to use marathons effectively. So approximately as a whole 10 to 11 chapters we are covering. As per ICS study material, you are having totally 14 chapters, but I'm covering 10 to 11 chapters. If at all you are perfect in these chapters, I'm telling you, you can easily score 40 plus for sure. Getting, you can easily score only from tax 40 plus, getting it. So what I am not covering, TDS chapter I'm not covering, and exempted incomes chapter I'm not covering, getting it. So rest all other topics mostly I am covering. Rest all other topics, approximately 10 chapters, I am covering, getting it. So I don't want to tell any further information. Now the material which I used in this marathon, I'll be using my book, my tax book. You can download it from our applications, REST application. You can see above me there is a white logo, REST for CACMA. So you open the tab, you can find the material inside that if you just check it. Alternatively, you can also download from our website. There is a website called restofacacma.com. In that website also you can download. And believe me, listen to this marathon revision at standard speed. You will be having clarity like anything. Suppose in this part 1, in set off and carry forward, I covered a crucial point: unabsorbed depreciation, business loss, how to identify unabsorbed depreciation, all that. In chapter 6A, I specifically highlighted on 80G, 80G, 80JJAA, 80QQB, and 80D, 80CCD, getting it, 80DD, all this. Almost each and every section in chapter 6A I have covered, getting it. Only on chapter 6 you will find 2 to 2 or 15 minutes revision only in this, getting it. So clearly covered each and every topic, and concerned problem also. Almost whatever topics we covered, there is a problem which we solved in this classroom itself. So it is like, first you will have clubbing provision, then immediately test your knowledge questions on clubbing. Then you will have set off and carry forward theory we will discuss. Then almost 10 questions we solved, some 7 or 8 questions we solved. Then chapter 6 here, some 5 to 6 questions we have solved, getting it. So use of this marathon wisely, and believe me, you will have whatever the open ends, whatever the doubts that you are having, everything I will close it. So if you listen to this marathon, you will have a concrete clarity on all these concepts, getting it. That's it. So this is the timelines within which I'm going to upload my upcoming marathons also. Kindly permit me, kindly excuse me for not uploading other chapters like TDS, TCS, because right now itself I'm running out of whatever the time, because I'm having many other preoccupied commitments. So in spite of it, I'm working hard and then giving you all these marathons. Take care, all the very best. By the way, from our Shrestha team, we already uploaded law marathon, costing marathon, GST marathon is uploaded, even economics for finance and financial management are coming in the coming week. So that's it. Make use of it wisely and go to my YouTube channel. Of course, you're watching this in my YouTube channel. Go to playlist November 23 marathons. Inside that you will find other subjects, company law, other laws, costing, all that. And believe me, all these marathons are going to be different from what are available in the market generally. So our marathons are little bit clear, very clear. I can confidently tell you that the marathons which we upload are very clear, very rare. in this CA fraternity, especially faculties, very rare, very less number of faculties give marathons which are very clear. Getting it? And I'm very happy to say that we are one among them. Okay, have a nice time. All the very best. Continue watching. So let's start revision of clubbing provisions. So clubbing provisions were discussed under section 60 to 65. At CA Inter, we don't have this section 65. In the study material, it was not given. That is related to sending of notice by the department to the SSC. Getting it? So that we don't have. That's a very small provision, but anyhow, we don't have in our syllabus. Now, if you look at the book, like if you look at the actual chapter name given in the ICA material, income of other persons included in SSC's total income means actually the income is received by somebody else, and that income is included in your total income, in your taxable income. So that is not taxable for him. The recipient of income is not liable for tax, but the payer, the other person is liable to pay the tax. Getting the point? Like the logic is very simple, because you might have diverted the income, or you might have temporarily diverted the asset so that income can be, so that a slab limit can be, utilized, a benefit of slab. Generally, when two or more members are there in a particular family, if one person of the family is earning higher income, in order to minimize the tax liability, they will shift income of his, like they will shift his income to another family member. Now that shifting is also not allowed by the department. If you shift the income, that will be retaxed in your hands and you have to pay tax on that. So that's what clubbing provision is all about. So in that, the first section is section 60. So here what SSA is doing is simply transferring the income, not transferring the asset. Suppose you are having some asset and from that asset you are getting some income, and without transferring the asset, you are just transferring the income. Suppose you have given somebody a loan. On that you are getting interest. Whenever you give any loan, if you are getting any interest, that interest is taxable under which head of income? Other sources generally. Now you told the other person, please give that interest income to my son. Please give that interest income to my brother. Getting the point? You diverted the income. Now you are escaping from the department saying, no, that income I am not receiving, that income is received by my brother. Getting it? So I gave a loan, but I am not getting the income. The income is being received by my brother, so it is not taxable in my hands. No, section 60 says, if you transfer income without transfer of asset, that the income is taxable in the hands of transferor only. So in exam they'll give you made a bank deposit, you gave a loan, on that you are getting some interest. That interest you told the other person to pay to somebody else, but the loan or the deposit, that and all is in your name only. So you just transferred income, so that income is taxable in your hands, in the hands of the transferor. Getting it? Next. Now, so that's about this one. Next, suppose now since this provision is saying if you don't transfer the asset and just transfer the income, clubbing provision will apply. What if I do transfer of asset also? What if, example, I have a car. Example, I'm having a car which I'm using it for renting business. Getting it? So I'll do one thing. I will transfer this car to my brother. I will transfer this car to my relative, or I will transfer this car to one of my family member. Now, see, generally, if I transfer this car to somebody else, whether I sold it or whether I gifted them permanently. If at all on that any income they are getting, that is taxable in their hands only, because the asset is not mine anymore. What if you transferred with a condition of revocation? Revocation means you can reverse the transaction. You can reverse the transfer. So that transfer is called as revocable transfer. What is it called as? Revocable transfer. What is a revocable transfer? You transferred some asset to somebody on a condition that any time you can get back the asset, which means you did not transfer permanently. If you transfer to somebody permanently, suppose simple, I purchased a car which I'm using it for my business purpose, like hiring, I'm renting the cars, I'm getting income. If I sell this car to somebody else, I sold it or I gifted to somebody, no more relation with that car anymore. Now on that car, after I transferred, if any income is there, that is taxable in their hands only, right? So how the hell it is taxable in my hands? No. However, if I transfer with an agreement mentioning I can get back this car at any time, which means the underlying intention is very clear. You are transferring to evade tax. So if you are transferring any asset under revocable transfer method, not a permanent transfer, you are not permanently transferring to somebody. See, if you transfer it permanently, now you can't get back. Even if you fight like anything, you can't get back. You gift it to somebody. As per gift, there is a law for gift. As per the gift, once you gift it, that becomes their own property. You can't again claim back. Once you sell, you can't claim back. Sale of goods and all very clear. Ownership, once you transfer it, is no more. Suppose if you transfer it with a condition of revocation, with an agreement of revocation at any time, on that income, of course, once you transfer to somebody with a revocable transfer, I know you will revoke it after some, 5 years or 6 years or 10 years, whatever the timeline, you will revoke it. Sometime you can revoke, right? Anytime you can revoke, right? As long as, revocation clause is there in a transfer, entire income on the transferred asset is not taxable for the other person, it's taxable in your hands only. So any income arising on transfer of an asset under revocation, that is taxable in the hands of transferor only. Now that is what section 61 says. Now section 63, this section 63, what it says, see, like 61, 62, 63, these three talks about revocation clause only. Now these sections says the following transfer is not treated as revocation. The following transfer is not treated as revocable. Generally, what is a revocable transfer? If I transfer any time, if I get back, even after 20 years, even after 30 years, if I get back the asset, that's a revocable transfer only. If I have a right to get back the asset later point of time, I transfer today, but I can get back it after 30 years again. I will get back. The transfer will be reversed. Even if it is after 30 years, even if it is after 40 years, even if it is after 50 years, doesn't matter. It's a revocable transfer. Suppose, I transferred it to my brother. I transferred asset to my brother. And in the agreement, I clearly mentioned, I cannot get back this asset. I cannot get back this asset during the lifetime of my brother. Like what I mentioned, I transferred this asset genuinely to support my brother for his income purpose. Getting it? Throughout his lifetime, he can enjoy that asset. How long he survived, that I don't know. That only God decides. So I transferred the asset in such a way that my brother's throughout his lifetime, whatever income is there, he will only enjoy. I cannot get back, even if I try my best, even if I go to Supreme Court, even if I file a case anywhere, I can't get back the asset. But once my brother expires, once my relative expires, once the concerned person expires, then I will get back this asset. Now, here also I am getting back. Technically speaking, it's a revocable transfer because here some point of time you are getting back, right? That's a revocable, technically speaking. But income tax law assumes that this is not a revocable transfer. Income tax assumes that this is not a revocable transfer. So suppose if I transferred in 2023-24 year to my brother one asset, throughout his lifetime, I cannot get back this. Now, 23-24 onwards, he is only enjoying the income. Now, is that income subject to clubbing in my hands? Is that income taxable in my hands? No, it is not taxable. That's it. So this is what 61, 62, 63 collectively say. If you transfer any asset under revocable method, income on that asset is taxable in your hands only. I know temporarily somebody is the owner, but still it is taxable in your hands only. Suppose if you transfer an asset to somebody on a condition that during their lifetime of the transferee or beneficiary, you cannot get back the asset, then that is not treated as revocable transfer. Accordingly, if you cannot revoke the transfer during their lifetime, any income on that asset, that is taxable in the hands of transferee, the recipient only, not transferor. I hope you are clear. So that's one segment of clubbing provision. Then now we have section 64. In section 64, we have these clauses. 64 subsection 1. 64 subsection 1, clause 2, clause 4, clause 6, clause 7, clause 8. These two provisions talks about transfer of asset to daughter-in-law. These two provisions talk about transfer of asset to spouse. So here transfer of asset to daughter-in-law. Here spouse working in an organization where the other spouse has substantial interest. So these are the remaining provisions in the clubbing. 64 subsection 1, clause 2, clause 4, clause 6, clause 7, clause 8. Now what are they? So first let us look at this point. In this, many students have confusion regarding especially Okay, fine. Let me slowly discuss. So what is that 64 subsection 1 clause 2? By the way, whatever the content I told you, that is given in our material. We have even given problems and even answers also we have given at this book. So you can download this book anyhow on the website srestafacacma.com. In that PDF resources were there. Inside that P4 or P3, new scheme P3, old scheme P4. So the book is same exactly for both old and new. So you can download and have a look at it. Getting it? So now what I'm going to discuss is this provision. So 64 subsection 1 clause 2. Now what this provision says, suppose there is an organization, it may be company XYZ limited, or it may be LLP XYZ LLP, or it may be partnership on XYZ and co, or it may be a society, or it may be my own business, sole proprietary concern. So in my business or in an organization where I am having, suppose Mr. Ram, suppose if I am having in these organizations substantial interest. What do you mean by substantial interest? Substantial interest means, first of all, more than 20% voting power, more than 20% profit sharing ratio. In case of company, voting power is considered. In case of remaining organizations, profit sharing ratio is considered. So if a person is having 20% or more profit sharing ratio or 20% or more voting power in a particular organization, then this person is said to be having substantial interest. Now to count this substantial interest, how to count 20%? It is the individual, whoever individual is that fellow voting power plus his relatives voting power, that should also be considered. Now what is covered in relative? Brother or sister, spouse. Getting it? Lineal ascendant or lineal descendant means my 3 generations downward, 3 generations upward. Lineal ascendant means parents, grandparents, great grandparents. Lineal descendant means children, grandchildren, great grandchildren. Getting the point? So that is what lineal ascendant, lineal descendant refers to. So now to count whether in a particular company, do I have substantial interest? How to count? So what is my shareholding? Check out. Plus my relatives, my brother, my sister, my spouse, my parents, grandparents, great grandparents, my children, grandchildren, great grandchildren. So all of these voting power counted, total it, sum it. What is the percentage? If it is 20 or more, then I said to be having substantial interest. Okay, you are having substantial interest in one company. Fine. What is the consequence? Suppose in this company, my wife is working. Example, my wife is working, or otherwise my wife is having substantial interest. I am working in that company, or I am having interest. My wife is working in that company. Now immediately you have it out. Sir, what if both of them are having? First, let me complete this provision, then I will discuss about that. Suppose in a company where I am having substantial interest and my wife is working as an employee, whatever this company paying salary, yearly they are paying 6 lakhs per annum salary. This entire salary which my wife is getting from this company, in which me and my relatives put together are having substantial interest. Getting the point? So whatever salary she is getting, that is not taxable in her hands. That is taxable in my hands. That is taxable in my hands as income. Able to understand? Further, remember, XYZ Limited is a company which is paying salary to one of the employee. For XYZ company, it is a deduction under 37 in PGBP. And remember, for them, 40A subsection 2 will apply. 40A clause 2 will apply. As per that, this, my wife, she will come under specified person. Able to understand? Getting it? So, if at all, for XYZ Limited, if at all the salary paid to my wife is a specified person, for them also, 40A2 disallowance will apply. In addition to that, whatever salary they are paying to her, that is again taxable in my hands as income. So you need to be very careful. Getting it? So whenever this provision is given, what are the tax implications? You should talk about 40A2 and you should also talk about 64 subsection 1 clause 2. But anyhow, this much in-depth knowledge is not required at CA inter level. So this is enough. So in a company where I am having substantial interest, my wife is working, whatever salary that she is receiving, that entire salary is taxable in my hands. Very simple. However, this clubbing means what? Others' income is taxed in my hands. Clubbed means others' income is clubbed in your income. So that's what clubbing means. Now, when this clubbing will not apply, suppose company is paying salary, right? Company is paying salary to my wife, right? If at all my wife is having any professional and technical qualification and experience For that qualification and experience only company is paying the salary. If I prove to the department, sir, in this company they need an employee and my wife is having all the qualifications, so she is working. If somebody else also is working, we will pay 6 lakhs only. For her also we are paying 6 lakhs. How come you say that I influenced and got this job? So if at all my wife, if at all my spouse is getting salary because of her professional and technical qualification, clubbing will not apply. This is what main provision of 64(1)(2). Now there is a clarification given. What if in the same company both husband and wife, both of them are working and both of them are having substantial interest? Generally you will see these kind in private limited companies. Getting the point? Suppose husband and wife, getting it, both of them are having substantial interest in this company and both of them are working as directors in the company. Both of them are receiving remuneration. Now what? If at all both of them are receiving remuneration from the company for the skill and talent, professional qualification and education and technical qualification and skill, clubbing and all will not apply. Suppose if at all they don't have any qualification, they don't have any professional skills and all, just for tax evasion purpose they are getting salary from company and utilizing their slab limits, and company is liable for flat 30. So indirectly they are, as a whole, tax planning they are doing. If at all they are getting income, both of them are, they are getting income, and the exception will not apply. So both of them are having substantial. Now how to club? First of all, calculate husband income separately, total income. Excluding which income? Excluding amount received from XYZ. Excluding salary received from that organization, from that concern, from that entity, from that enterprise. Excluding the concern's income, calculate total income of the husband. Same way, calculate total income of the wife. Getting it? Excluding whatever. Suppose wife is getting 7 lakhs per annum salary, husband is getting some 8 lakhs per annum salary from this particular concern where both of them are having substantial interest. Now, excluding this 8 lakhs, excluding this 7 lakhs, calculate their normal total incomes as per provisions of income tax law. What is total income? Getting it? Sum of all heads of incomes, Setoff and carryforward and clubbing, then you will get gross total income. So, minus deductions, then you will get total income. So, that total income you calculate. Whose total income is higher? Whose total income is higher? Excluding this income. Excluding only this income, whose total income is higher? Just check out. Now, if at all husband's total income is higher, if at all husband's total income is higher, now they are getting 8 lakhs plus 7 lakhs, right? Like they are getting 8 lakhs husband, 7 lakhs. Entire 15 lakhs is taxable. Entire 15 lakhs is taxable in the hands of the husband. Suppose if wife total income is higher, then entire 15 lakhs is taxable in the hands of the wife. That's it. Now once, suppose for the first time in 22-23 previous year we clubbed in the hands of the husband, this entire 15 lakhs we tax it for husband. 23-24, no, wife total income is higher. Now in that next year, whatever both of them are receiving remuneration rate, where it is clubbed? Husband only. So the department clearly said, the income tax law clearly said, once clubbing applied in the hands of one person, the income will be clubbed in the hands of the same person for all the succeeding assessment years, unless the assessing officer changes it. Understood or not? So that's 64 subsection 1 clause 2. Then 64 subsection 1 clause 4 and clause 6, both are more or less similar. Getting it? Now what is this? Here what happened is, one particular spouse transferred an asset for inadequate, or actually the law uses the word very clear, without adequate consideration, transfer asset other than house property. What is it? One spouse is there, example husband or example wife, transferred an asset. Which asset? Any asset other than house property. If I transfer my car, or if I transfer my, some other land, vacant land, or if I transfer my business related building, whatever, getting it, but not house property. House property means what? That land or building, that building or land and building which is accessible under house property. Why? Because for house property section 27 deemed owner concept is applied. I hope you remember, in house property we have a concept called deemed owner. If any transfer of house property without adequate consideration to the spouse, then the transferor is deemed to be the owner. However, if the transfer is in connection to live separately, then deemed owner concept will not apply. So that is house property. Remaining all other assets, if you transfer to spouse without adequate consideration, without adequate means what? Zero consideration, or consideration is less than market value. So if you transfer any asset for without adequate consideration to whom? To spouse. to spouse. Now on this asset, no, on this asset, no, she is getting yearly some 2 lakhs income, yearly some 2 lakhs or 3 lakhs or 4 lakhs, whatever the income. That entire income is taxable in the hands of the husband. Now you see here it is not a revocable transfer. I transferred permanently. I gifted my wife the car permanently. I can't take it back. But since she's your wife, since she's spouse, getting it, though it is not a revocable transfer, it is not covered under section 61 purview. You transferred permanently. If you transfer temporarily, 61 we will apply. But you transferred permanently. You can't take back the asset again from your spouse. But then you transfer to spouse, na. So we consider it as tax evasion. We consider it as you are trying to reduce your tax burden by slab utilization. Getting the point? So if you transfer any asset to spouse without adequate consideration, so even if you gift your wife any property which gets some income, that income is taxable in your hands. That income is taxable in the hands of the transferor. So that's what this provision. Now for this, one exception is there. When this provision, clubbing cannot be applied. Suppose if the transfer is made for adequate consideration. If I sell it, she bought it by paying me proper consideration. I sold it and I paid even capital gains tax on that also. Everything is clear. And if I transfer to her in an agreement to live apart, in a situation of divorce, getting it, if both husband and wife are not living together, they are living separately. So in connection to that, I transferred some asset so that she'll get income or so that he will get income. Clubbing will not apply. What is it? Clubbing will not apply. Are you clear? Suppose, no. Okay, fine. Suppose, husband is there. He transferred some, car to wife. Getting it? This car, no, she is renting. So she is getting monthly 50,000 rupees profit on that car. Now this entire 50,000 is taxable in the hands of husband. Fine, very clear. Suppose, no, husband gifted cash to wife. Husband gifted cash. I just gave cash gift to my wife. Now my wife is receiving cash gift more than 50,000 rupees. Let us assume I gifted 5 lakh rupees. Okay, she received a cash gift worth of more than 50,000. Is it taxable in her hands under other sources? No, because received from relative, now spouse, na, so exempted. Now what she did, she's very clever. She did not buy any saree. She did not buy any other shopping, nothing. She went and started a business, or she already had a business. In that business, she invested as a capital contribution. She just, took that profit, took that cash gift and invested in the business. Now from this business, no, she is getting some profit. Now from this profit, whatever profit due to my gifted asset, due to my gifted cash, whatever profit attributable, that is clubbed in my hands. How to identify this profit? This is one topic where many students have confusion. Getting it? If spouse transferred any asset to wife and that asset is invested by her in a business, how to apply clubbing provision on that? So getting it? Proportionate profit is, to be clubbed. How to calculate proportionate profit? You and me cannot decide. Law has given a formula. Very simple. So what is the profit for that year? What is the profit for that year from that business identified, multiplied by what is the gifted asset value or cash value or gifted asset value as on 1st April of relevant previous year. As on 1st April of relevant previous year, what is the gifted asset value which is invested in business? Invested in business as on 1st April of that year, how much is invested? Divided by what is the total capital? Total capital means what? Opening capital plus opening capital, which includes what? Wife's own capital plus gifted capital. Whatever husband has given us, that gifted capital. Total capital as on 1st April of relevant previous year. As on 1st April of relevant previous year. Suppose, for that year, she has got a profit of 5 lakhs. As on opening date, as on 1st April of 2022, getting it? Because I gifted her on, let us assume, I gifted her on, 15th April 2022, I gifted her cash. She immediately invested on 16th April into the business. Now, as on 1st April, how much is my gifted asset? Remember, I gifted her on 15th April, not on the 1st April. So, as on 1st April, opening date of the financial year. So, how much is my capital? 0 divided by, what is total capital? Denominator, whatever the number, doesn't matter. The 5 lakhs multiplied by 0 is equal to 0. So, for this year, clubbing will be 0. I hope you are clear. Now, you know how much I gifted, by the way? 5 lakhs I gifted. But as on 1st April, I did not gift anybody. I did not gifted her. I gifted her on 15th April. As per income tax circular, when one spouse gifted some cash or asset to other spouse and she invested in the business, for that year she got any profit, clubbing will apply only if the gifted asset is there from the beginning of the previous year, not in between of the previous year. If at all in between I gifted and invested, clubbing for that year will not apply. Suppose now clubbing will be 0. Suppose opening capital as on 1/4/2022, my wife's own capital already there 10 lakhs. 15th April, how much I gifted? 5 lakhs. For that year, profit how much? 5 lakhs. Total closing capital how much? 20 lakhs. Now next year, this will become opening capital, right? So 23-24, she has got a profit of 10 lakh rupee multiplied by, as on 1st April 2023, what is the total capital? 20. Out of this, how much is my gifted asset? Very good. 5 lakhs is my gifted asset. Sir, last year, now you see gifted asset as on 1st April 2022, how much? As on 2023, as on 2020, because I'm doing for 2020, 23-24. So as on 1st April 2023, how much is my gifted asset out of 20 lakhs? Mine is only 5 lakhs. Because she did not withdraw. So she invested it in 15th April 2022, as she brought. Next year also started. So next year opening date, how much my capital is there? 5 lakhs is there. Now clubbing will apply. So 1/4. So 10 lakhs multiplied by 1/4 is equal to 2.5 lakh. Okay. For the previous year 23-24, out of 10 lakhs, what is it? Out of 10 lakhs profit that she is earning, out of that 2.5 is subject to clubbing in my hands. I hope now you are clear with respect to this point. So very simple. When I gifted her, check out. If I gifted her between the previous year, between 1st April to 31st March, between I gifted, and that is invested in business, for that year she got profit, 0 clubbing, because opening date of that year, how much is there? My gifted asset, 0. I gifted around 15th April, not 1st April. Able to understand. But for the next year, in the next year opening date, my capital will be there now. So for that year, whatever profit she gets, proportionately will be clubbed. So that's it. Suppose I gifted her some money, she went and invested in a partnership firm. She's a partner in a partnership firm. On that she's getting interest. Interest is as it is clubbed, because interest on that 5 lakhs which she invested, that is out of my gifted asset, that will be clubbed. Suppose she is getting profit from partnership firm, share of profit, exempted, because share of profit received from a partnership firm is what? Exempted. Suppose she invested in sole proprietary, this is how we should calculate. Be able to understand. Suppose she invested that in a company and she's getting dividend. Dividend is clubbed. Dividend will be subject to clubbing. Be able to understand. So that's it. So that is what 64 subsection 1 clause 2 is all about. So in this, I've clearly explained everything. Clause 4 is also over, where transfer asset is invested in the business. Getting it? Illustration 5. We have given you illustration 5 in our book, and even in test your knowledge question also we have given one question. So what I will be doing is, anyhow, in this marathon, I'm going to upload the main provision and test your knowledge questions also, which I solved and explained. So that also I'll be uploading for your easy reference. Getting it? Next. Now we understood clause number 4, right? Now what is clause number 6? Clause number 6 is very simple. Suppose you did not gifted her asset directly. You gifted the asset to some friend, your friend or your brother. Your brother gifted to your wife. That's an indirect transfer. Getting the point? Indirect transfer also, it is subject to. Now in here, to my wife, who transferred? My brother. But the law assumes I am the transferor. The clubbing will be in the hands of the deemed transferor. That is what clause 6 says about. So, in clubbing, you have an example called cross transfer. What is it? Cross transfer. Suppose I gifted an asset to my brother's wife, not to my spouse, but to my brother's spouse. In return, my brother gifted to my wife's, my wife. Getting it? So, indirectly, I gifted to my wife. Indirectly, he gifted to his wife. Getting it? That's a cross transfer. So, they both are circuitous transaction. Getting the point? They both are interconnected transaction. So, clubbing will apply in the hands of deemed transferor. That's it. Next. So then, suppose I did not transfer to my spouse. I transferred it to my daughter-in-law. 64 subsection 1 clause 7 will apply and clause 8 will apply. If I directly transfer to my daughter-in-law, clause 7. If I indirectly transfer to my daughter-in-law, clause 8. Now, how clubbing will apply? Exactly. Instead of spouse, in clause number 4, what we discussed? Spouse. Instead of spouse, you transfer to daughter-in-law. That's it. provision is exactly same. Son's wife, if you transfer any asset to son's wife without adequate consideration, whatever income your son's wife, daughter-in-law, she is receiving, that is taxed in the hands of the transferor. Suppose if the daughter-in-law invested in a business, how to club? Same. We have seen now, as on opening date, how much is the capital from the gifted portion divided by total capital as on opening date. In that proportion only clubbing will apply. So the provision is exactly same. Just that clause number changes, just that the transferee changes. In clause number 4 and 6, the transferee, the beneficiary is spouse. Whereas in clause number 7 and 8, the beneficiary is daughter-in-law. That's it. So the clubbing provision is over. Clubbing provisions are over. Hardly half an hour we spent. Now there is another provision, 64 subsection 2. What is 64 subsection 2? What this provision says? This provision says, suppose an individual is there. He is a member of HUF. He is a member of HUF. Now this individual is having some personal property. By the way, before this, one important observation. Now 64(1)(4) clause number 6. There any asset you transfer excluding house property. Whereas in daughter-in-law case, no, even if you transfer house property to daughter-in-law, on that income, whatever she is getting, first compute income in her hands as income from house property. That income is subject to tax in the hands of the transferor. Because for house property transferred to daughter-in-law without consideration, 27 deemed owner concept is not there. So clubbing provision only we will apply. Whereas for transfer to spouse, no, house property provision will apply. If I transfer house property, if I transfer any other asset, clubbing provision will apply. Fine. Come back to 64 subsection 2. Suppose there is a HUF, inside that there is one member. Now this individual, no, he is having his own personal business also. Out of that, he is earning so much and he constructed some buildings and all. Now one building or one asset, one property, he transferred it to HUF at free of cost, without consideration, without adequate consideration. Now this individual who is a member of HUF transferred his personal property into HUF. He throws that property into HUF property. Getting the point? Now whatever now HUF is receiving income on that property, that is not taxed in the hands of the HUF, that is taxable in the hands of the transferor only. Suppose no, later on after transfer is over, everything is over, HUF got partitioned. Now whatever total properties of the HUF is there, no, that is distributed equally to all the brothers. Now how clubbing will apply? Suppose no, I am the individual who originally transferred the HUF, no, so I transferred 100 crore worth of property to my HUF, one property gifted. Now on this 100 crore, whatever HUF is getting income, no, 10 crore income HUF is getting, that entire income is taxed in my hands. But once after partition, me and my wife, we are receiving only 2 crore income on that property. Then after partition, only 2 crore is subject to clubbing in my hands. Remaining others share is not subject to clubbing because now it is not HUF property anymore. After partition, the property is got distributed between all the brothers and sisters. So no more clubbing will apply. Only my share and my wife's share, only that will be taxable in my hands. Before partition, 100 crore worth of property I gifted, no, on the 10 crore income HUF is getting, right, that is entirely subject to clubbing in my hands. With this, clubbing provision is over. 64 subsection 2, everything we have discussed. That's it. Okay, so immediately I have attached test your knowledge questions also, which I solved using all these principles. You just watch it. You will feel a literal revision of income tax, complete income tax with the provisions and answers. You will feel like a revision, absolutely. In our regular class, we will be discussing very in-depth. The way we explain everything is completely different. So that's why it's a revision class. Revision class is revision class. That's it. Okay, take care. Yes, finally, test your knowledge questions in clubbing provisions. Mr. Sharma has 4 children consisting 2 daughters and 2 sons. So he's having 4 children, 2 daughters and 2 sons. The annual income of 2 daughters for 9,000 and 4,500. So for each daughter, one daughter 9,000, another one 4,500. And of sons, it is 6,200 and 4,300. Now remember, they have not given any information regarding the age of the children. Let us assume all the 4 children were minor. The daughter who has an income of 4,500. So one daughter is there, no, who is having 4,500 income, no, he is suffering from disability. So if a minor child is suffering from disability, do we apply clubbing provision in respect of their income? No, that income is taxable in their hands only. Compute the amount of income earned by minor child to be clubbed. Very simple. So one daughter is getting 9,000 income, daughter 1, this is subject to clubbing. Daughter 2, 4,500 is not subject to clubbing. Son number 1, 6,200, son number 2, 4,300. For all of them, 1,500 exemption is there, na? So balance is what? 7,500. So here it is 4,700. Here it is some So 2800. So how much is total to be clubbed? 7500 plus 4700 plus 2800. 15,000 rupees is to be clubbed. Simple. Answer is over. Yeah, the answer is 15,000. Income to be clubbed. Getting it? See, you should present like this only in exam. That's why I always ask you, I always insist on you to read the answer once again after listening to my class. I am only here to explain this. Now, question number 2. During the previous year 22-23, the following transactions occurred in respect of Mr. A. Okay, let us see. Mr. A has a fixed deposit of rupees 5 lakhs in Bank of India. So in a bank, he has a 5 lakh deposit. He instructed the bank to credit the interest on deposit at 9% from 22 April to March 23, means 1 full year interest, to the savings account of Mr. B, son of his brother, to help him in his education. So my brother is there to his son. I instructed the bank. So 5 lakhs multiplied by 9%, approximately 45,000. I told bank to transfer this income to my brother. Transfer of income without transfer of asset. Tax in the hands of transferor. So it is taxable in the hands of A only. Correct? Now Mr. A, he is having 75% profit share in a partnership firm. Okay, he is having substantial interest in the firm. Mrs. A received a commission of 25,000 from the firm for promoting sales of the firm. Okay, so for promoting sales of the firm, she got commission and she has no technical professional qualification. So this 25,000 is taxed in the hands of A. Okay, next. Mr. A gifted a flat to Mrs. A. Transfer of house property to spouse on April 1st, 2022. On April 1, 2022. Let us assume it is without consideration. See, they said gifted. No, gifted means without consideration. Any transfer of house property to spouse without consideration, the transferor is deemed to be the owner. So, income from house property computed is almost 52. For entire 52,000, it is taxable in the hands of A only because of section 27 deemed owner concept. Mr. A, he gifted 2 lakh rupee to his minor son. A gift to son, for son it is exempted. Who invested the same in a business and he derived income of 20,000 from the investment. So he invested in a business, he just got 20,000 income. Getting it? Let us assume there is no skill or talent in that business. So this 20,000 is taxed in the hands of either of the parent whose total income is higher. Now, till now we are only seeing Mr. A information, right? Yes or no, Mr. A information. So in whose hands this 20,000 rupees is clubbed, we don't know. Mother's income details also I think they have given it below. So let us see, let us wait for that. Mr. A's minor son derived an income of 20,000 through activity involving application of skill. So he did some another business where his skill is there and got 20,000. When skill is used and got profit for that minor child, this is not subject to clubbing at all. Whereas from D, this business income is subject to clubbing. This business income, they specifically told skill and talent, so not subject to clubbing. Fine. During the year, Mr. A got a monthly pension of 10,000 rupees. He had no other income. Mrs. A received a salary of 20,000 per month from a part-time job. So she is getting salary. Examine tax implications in each of the transaction. Compute the total income of A and Mrs. A and their minor child, assuming he is not opting for 115 BAC. Now fine. Mr. A, Mrs. A and minor son who is having business. Getting it? Minor son, business income with the skill and talent. Business income with the skill and talent. It is taxed in the hands of minor only, remember. Mr. A is getting pension income, correct? Mr. A is getting what? Monthly pension of 10,000 rupees. So which means how much it is? 1,20,000 rupees. Mrs. A is getting salary income. How much is the salary? He is getting 20,000 from a part-time job. So which means 2,40,000 is his gross salary minus deduction, standard deduction under section 16 is there, which is 50,000. So which means my wife's income is 2,40,000 minus 50, which is 1,90,000 only. Now next 4. Now we will see. Now first case, Mr. A had a fixed deposit. This 45,000 is clubbed in the hands of A only, no. So clubbing under section 60. Transfer of income without transfer of asset. How much is that? 45,000 is taxed in the hands of the Mr. A. 5th one. Now 64 subsection 1 clause 2 clubbing. Clubbing under section 64 subsection 1 clause 2. How much? 25,000. Remuneration to spouse in a concern in which husband is having substantial interest, taxed in the hands of the husband. Sixth one. C point, you see. Mr. A gifted a flat to spouse. 52,000 was the income. So section 27, deemed owner concept. Accordingly, house property income was how much? House property income is how much? 52,000. Then they are having minor incomes. This is not subject to clubbing. Whereas D point is subject to clubbing. Now, in whose hands it should be clubbed? Mother or father? We should see that. Now, before minor income is clubbed with parents, whose income is higher? We should check. Now, let us total it. Now, let us total the incomes. So, minor income is 20,000. So, this is closed with that. Now, here, mother income is 1,90,000 before minor's income is clubbed. Father income 1,20,000 plus 45 plus 25, 52,000. How much? 2,42,000. 2,42,000. By the way, he is getting pension. Mr. A is getting pension. This pension is, let us assume, from employment. This pension is from employment. This is taxable under income from salary. Pension received by Mr. A, no, it is taxable under income from salary. So Mr. A will also get 50,000 exemption. Sorry, I forgot to mention. So what is it? 70,000 only salary income. Now let us check. So 70 pension. See, pension is received from employer generally. If any pension is received by employee from the employer after retirement, still it is taxable under salaries only. 70 plus 45. Once it is taxable under salaries, there is a standard deduction up to 50,000 is available under salary set of income. We have not yet covered salary set of income. We'll discuss. So now 70,000 is only pension income which is taxable. So 70,000. Remember, this is not family pension. Family pension means it is a pension received by family members of the deceased employee. Employee died, family members receive. That is taxable for them under other sources. If the person is directly receiving pension, which is not a family pension, taxable under salary set only. 70,000 plus 45,000 plus 25,000 plus 52,000. So it is 1,92,000 ma. It is 1,92,000. So close, no? So close. Now tell me, mother income or father income? Whose is higher? Father income is higher. Now, one point is there here. What point? Father no, he gifted 2 lakhs to his minor son who invested in the business where he got 20,000 in income on that investment. They have not given any skill or talent points. So this is subject to clubbing. Now whose hands it is subject to clubbing? 20,000 is taxed in the hands of the parent. Now remember, 1,500, 1032 exemption. So now 18,500 is clubbed. So 1,92,000 plus 20,000 minus 1,500. So what is the father income? Ultimately total income 2,10,500 is the father's income. Mother's income, final income is 1,90,000. Whereas minor son income from the business where he is having talent 20,000. Yeah. So pension income is taxable under income from salary. So that's it. House property, this one. So income before including 64 1 year minors income clubbing. Before including minors clubbing, whose income is higher? Father's income is higher. So accordingly, so in their hands, this 20,000 minus 1,500, 18,500 is clubbed. So that's it. So we have got the correct answers. Fine. Next, you read this entire answer carefully. You will feel like a revision of the entire chapter. Please. Question number 3. Mr. A has gifted a house property valued at 50 lakh rupee to his wife Mrs. B. Section 27 gifted to spouse house property without consideration. 27 will apply. A transferor is treated as deemed owner under section 27. Who in turn gifted the same to Mrs. C, their daughter-in-law. It's okay. Afterwards, my wife to whom they gifted, that doesn't matter. The house was rented at 25,000 per month throughout the year. Compute the total income Mr. A, Mrs. C. Okay, fine. So my daughter-in-law income is how much? My income is how much? They're asking. First of all, I gifted this to my wife. So I am treated as owner. So 25,000 into 12, 3 lakh gross annual value. Municipal taxes they have not given. So that is the net annual value minus 30%. So 2,10,000. What is it? Mr. A income is 2,10,000. Whereas Mrs. C income 0 in this. That's it. Now they're asking another question. Will your answer be different if the said property was gifted to his son, that is husband of Mrs. C? If I gift a house property to son, no, clubbing will not apply. So entire 2,10,000 is taxable in the hands of my son. That's it. In case property was gifted to son, the income of 2,10,000 will be taxed in the hands of the son, not in the hands of the father. Whereas if it is gifted to my wife, no, entire 2,10,000 from the property being A's son's wife would be included in the income of A, applying the provisions of 27 and 64(1) clause 6. So therefore, it is not taxable in the hands of Mrs. C. So income from let out property is 2,10,000. That is taxable in the hands of Mr. A because he is treated as deemed owner under section 27 clause 1. Next, fourth one. A proprietary business was started by Srimati Rani in the year 2020. So 2020, okay, she started proprietary business. As on 1st April 21, which means 2021-22 information they are giving. As on 1st April, her capital in the business was 3 lakh. Okay? You see, her husband, no, he gifted another 2 lakh rupee on 10th April. Remember, as on 1st April, husband gift is not there. As on the beginning date of the financial year when the business is there. Business is started in 2020. So for 2020, whatever the income she got, nothing is clubbed. 2021 also, 21-22, as on beginning date, husband gift money is not there. Husband gifted on 10th April after the financial year is started. If the asset is gifted to spouse and she invested in the business, not as on the first date of that relevant previous year, but I gifted later on. For that year, clubbing will not apply for that year. You see now. So on 10th April I gifted. Therefore, for 21-22, if I have any profit, nothing is clubbed. Nothing is clubbed. Fine. To her, and such sum is invested by Rani in her business on the same date. Okay. 10th April I gifted 2 lakh rupee extra, and that is also invested. Now, Srimati Rani earned a profit from her business for the financial year 21-22, 1 lakh 50. Oh, for that year she got 1 lakh 50 profit. And you see, for the financial year 20-23, she earned 3 lakh 90 profit. Oh, so they have given next year information also. Now compute the income to be clubbed in the hands of Rani's husband for the assessment year 23-24. So they are asking for 22-23 previous year. Fine. Now I will check 21-22. For previous year 21-22, what is the profit of the Rani's business? 1 lakh 50. 1 lakh 50. What is the opening capital of the Rani as on the date? 3 lakhs is the opening capital. Yes or no? So 3 lakh. You see here 3 lakh. Now on 10th April, husband gifted no how much? 2 lakh. For this entire year, what is the profit? 1 lakh 50. So totally, what is the closing capital? What is the closing capital? Let us assume she did not withdraw single rupee of profit also. So 1 lakh 50,000 plus 3 lakh plus 2 lakhs. So total closing capital is 6 lakh 50. Which will be the opening capital for previous year 22-23. How much is the opening capital here? 6 lakh 50. Now remember, in this 2 lakh rupee gifted asset is there. Husband gifted the money, no, that money. So as on 1/4/2022, in the opening capital, gift money of 2 lakhs is there. Whereas on 1/4/2021, as on the date, is there any gifted money there from the husband? Zero. Therefore, for 21-22, 1 lakh profit, 1 lakh 50,000 profit, entire profit, not at all subject to clubbing. Entirely taxable in the hands of wife only. Whereas in 22 financial year, what is the profit they have given? 3 lakh 90,000. Out of this, how much is liable for clubbing? Out of 3 lakh 90, this 3 lakh 90 is profit for 22-23 year. So law assumes 3 lakh 90,000 multiplied by opening date. How much is the total capital? 6 lakh 50 is the total capital. Out of 6 lakh 50, how much is the gifted money? 2 lakhs. So this much only subject to clubbing. Getting it? 3 lakh 90 divided by 6. 3 lakh 90 divided by 6 lakh 50 multiplied by 2 lakhs. 1 lakh 20 is only subject to clubbing in the hands of husband of Srimati Rani. This is the answer. Now you should understand at least. For 21-22, why we didn't club anything? Why? What is the reason? In 21-22, 10th April itself we gave. But still, on 1st April, beginning date of the financial year, gift amount is not there as part of the capital of that business. So no clubbing for that year entire profit. Next year, this profit is reinvested. No, automatically, if nothing is given, what we assume, this entire profit is reinvested in the next year. So this entire profit will be added to the capital. As on opening date, on the total capital, whatever gift portion is that, proportionately we will club. So 1,20,000 is subject to clubbing. Capital contribution out of the gift, 1,20,000 is subject to clubbing. Therefore, income to be clubbed in the hands of Srimati Rani's husband for assessment year 23-24. Nothing but previous year 22-23 is 1,20,000. So 1,20,000. Please solve this entire problem once again. Please. Very important. Question number 5. Mr. B is Karta of the HUF, whose members derive income as below. So in a HUF, Karta is there. So the HUF members were given income from B's profession 45,000. Okay. Mrs. B's salary as fashion designer 76,000. Remember, this is gross salary minus 50,000 deduction is there. No. So what is the salary income of spouse? 26,000. Whereas professional income of husband is what? 45,000. So whose income is higher? Father or mother? Father. Fine. Let us see. Then minors and D, interest on fixed deposit 10,000 rupees. Getting it? This 10,000 subject is clubbing. Minor daughter P earning profit from sport, not subject to clubbing. He is winning from lottery income. D, minors and D, he's having lottery 1,95,000. Again, it is subject to clubbing. Now, father is having 45,000, business income. Mother is having only 26,000 salary income. Before clubbing of children's income, whose income is higher? Father. So, in the hands of the father, this interest is clubbed and winning from lottery is clubbed. So, 45,000 plus 10,000 minus 1,500. So, 8,500 in the hands of the father. Remember. And even 1,95,000 D's winning is also clubbed in the hands of the father. So father income is 45,000 and interest income 8,500 is clubbed. 1,95,000 is also clubbed in the hands of the father. Total father income is 2,48,500. Whereas mother income is just 26,000. Why? Because salary income is 76 minus standard deduction 50,000, 26,000. Now actually they didn't ask. They have not given the information relating what we need to compute. We computed the answer, final answer. But they have given tax implications. They just have given tax implications. So clubbing of income and tax implications. They just mentioned 45,000 is B's profession, taxable in the hands of B. Salary income 26,000 is taxable in the hands of wife. Income from fixed deposit 10,000 arise into minors and D. It is included in the hands of the father because before including this, father income is only great. But 1,500 exemption is available. 95,000 rupees for daughter, it is from sports. It is not subject to clubbing. 1,95,000 is lottery. This is again subject to clubbing in the hands of the father. That's it. That's what we did. Point you can ignore. Note point. Right now you can't understand that because this is related. That note point is related to TDS chapter. We'll discuss there. With this, all test your knowledge questions were also completed. See, logically, technically, test your knowledge questions you should solve on your own. But I'm explaining because you should not feel difficult. You try on your own, then you see these videos. Test your knowledge videos you should not see initially. I even covered that point in previous chapters also. Okay, take care. With this clubbing chapter is over. The next chapter will be, set off and carry forward. That's it. Yes, so let's start set off and carry forward revision. So the broad provisions of set off and carry forward were completely covered under section 70 to 80. And set off and carry forward provisions are discussed under chapter 6 of Income Tax Act. Income Tax Act is broadly divided into 23 chapters. Inside that, chapter 6, whereas clubbing provisions is covered under chapter 5. All heads of incomes were covered under chapter 4. Exempted incomes, all that were covered under chapter 3. Getting it? Chapter 1, preliminary rates of tax, all that will be covered in that chapter 1. Getting it? Definitions, all that. So like that, chapter 6. Whereas 6A talks about deductions. That's why we call it as chapter 6A deductions. Getting it? Fine. So in this 70 to 80, we don't have multiple sections at CA Inter, like 78, 79. So these sections we don't have at CA Inter. We only have at CA Final. So rest all other sections we have at CA Inter. Getting it? So now in the set off and carry forward, the sections are broadly divided into two categories. Set off related sections, carry forward related sections. Getting it? Now, set off related sections. For set off, we have section 70 and 71. These two sections talk about set off. Whereas 71B, 72, 73, 73A, 74, 74A, these 6 sections talk about carry forward. Section 80 is there. This is a condition. Section 80 speaks about a condition to carry forward these losses. In order to carry forward these losses, there is a condition. Except 71B, remaining all losses you can carry forward only if you file IT return within the due date. If you file the IT return, income tax return within the due date mentioned under 139 subsection 1, read with 139 subsection 3. If you file the return within this due date, then only you can carry forward all the losses except 71B. 71B talks about carry forward of house property loss. 72 talks about normal business carry forward of losses. 73 talks about speculation business loss to be carry forward. 73A, specified business losses to be carry forward. 74, carry forward of long-term capital losses. 74A, carry forward of losses from owning and maintaining resources. And 80, which talks about condition. What is the condition? You have to file IT return within the due date for filing 139(1) in order to carry forward all these losses except house property loss. So house property loss you can carry forward even if you file the IT return belatedly. Not only that, there is another loss called unabsorbed depreciation loss and unabsorbed capital expenditure on scientific research and family planning. These losses also can be carried forwarded even if you file the IT return belatedly. Now, what is unabsorbed depreciation loss? What is set off and carry forward? All that now we will be discussing. Now, there is a section called 73 which talks about intra-head set off. Intra-head set off. In some cases, it is also referred as inter-source set off within the same head of income. Within the same head of income. We all know that all the incomes under income tax law are broadly classified into 5 heads of incomes. Now, under a particular head of income, we may have multiple sources of income. Suppose I may have some 5 to 6 house properties, whereas all these house properties incomes, now they are taxable under house property only within the house property head. Getting the point? So now intra-head set off means what? Now suppose I may be having multiple businesses. So I have some business 1, I have some business 2, I have some business education, I have some business for some rice trading, I have some business wise, some wholesale, something. Now if I have a loss in one business, if I have a profit in another business, both are coming under same head of income, can I set off and pay lower tax on the lower income? Because after set off, the overall profit will come down. So can I set off? Yes, section 70 says loss from one source of income can be set off against profit from another source of income, provided both the sources of incomes are taxable under same head of income. Now, to this rule, there is an exception. By the way, please listen to these classes at standard speed only. Don't hurry up. Now, so that is regarding the standard rule. Now there are exceptions. 4 exceptions. We have exception 1, exception 2, exception 3, exception 4. No, like headwise we will come. So with respect to salaries, intra-head set off, no restriction, because in salary there is no question of loss. House property, intra-head set off within the head of income, set off of loss from one house with another house, there is no restriction. TGBP, there is a restriction. Loss from speculation business, can be set off only with speculation business profit. So what is the condition 1? So it says if you are having a speculation business and from that activity, if you make a loss, that loss you can set off only with the speculation business. You cannot set off with non-speculation activity. You cannot set off with other than speculation. Simple. I have multiple businesses. I have Shrestha Coaching Institute and I have income in this. And along with this, I am also trading in shares and securities in the stock market. So where I am getting intraday profits and all, intraday losses. Now this is called speculation activity. From this business, I end up with a huge amount of loss. Now can I set off my Shrestha business profits with this particular loss? No, because this is speculation activity. Loss from speculation activity can be set off only with the speculation profits. What is a speculation business? What is a speculation transaction? Where you are transacting in shares and securities or commodities, where you end up closing the transaction without delivery. You don't take any delivery. You are settling it without delivery itself. That is called a speculation. The following are not a speculation transaction. Hedging transaction is not a speculation. Derivatives transaction is not a speculation. Forward contract is not a speculation. Further, if a company whose main business itself is trading in shares and securities, for them it is not a speculation. For a bank, trading in shares and securities and commodities, not a speculation. For a loans and advances, NBFC company, trading in shares and securities is not a speculation activity. For all other organizations, if at all you are having normal business and also you are doing trading in shares and securities, the extent, the portion of trading in shares and securities, this is treated as speculation activity. This entire definition is given under section 43 of PGBP. I hope you are clear. Now, section 70 says what? Loss from speculation business can be set off only with the speculation. You cannot set off this loss with any source, any head of income. Next, another exception. Loss from specified business under 35 AD. If you are doing any specified business, getting the point, which comes under 35 AD section, out of 14 businesses which you are doing those activities, you have a loss. It can be set off only with 35 AD businesses. So if you are having any loss from specified business, it can be set off only with profit against specified business. Getting the point? Now, whether these specified businesses, are you claiming deduction under 35? Are they eligible for 35 AD or not? Doesn't matter. You are having loss from specified business. One hotel is there. You started long ago, 20 years ago. You have a loss. Getting it? Actually, that hotel is not eligible for 35 AD, but that comes under 3-star, 2-star, 3-star, 4-star, 5-star, 7-star. That category only. You have a loss. You have another hotel where you have a profit, which already claim a deduction in 35 AD, which is eligible for 35 AD. But at the end of the day, both of them are 35 AD businesses. Whether they are eligible for deduction or not doesn't matter. You can set off. Then another exception. Long-term capital loss. Now, PGBP related exceptions over. Now, capital gains within the head of income exceptions. Long-term capital loss can only be set off against long-term capital gain. In other words, long-term capital loss cannot be set off against long-term capital gain. Sorry, short-term capital gain. Getting it? You see, the restriction is only for long-term capital loss, not for short-term capital loss. Suppose if I have a short-term capital loss, I can set off against long-term capital gain. I can set off against short-term capital gain. Able to understand. Now, whether this long-term capital loss is 112A loss, 112 loss, whatever it is, you can set off only with the long-term capital gain. Suppose if I have a loss after set off, I don't have any other, still I have a loss, you can carry forward. Anyhow, carry forward portion, I'll come to that later. Next, another exception. Loss from owning and maintaining race horses, like you are running a stud farm. Stud farm means where you are breeding the horses. You are breeding for feeding horses and all for horse race purpose. So if you have a loss from that activity, race horses maintenance activity. Remember, if you participate in a horse race and you lost money out of that betting, that is not a loss under set off and carry forward. That is ignored. That is to be ignored. 115 BB section. 115 BB section says income from winning, income from lottery, income from so and so, whatever it is, flat taxable at 30%. If any loss is there on that, ignore. I am talking about which loss. You are doing some activity called owning and maintaining race horses. From that activity, you are having loss. That loss you cannot set off with any other income. You can only set off with profit from owning and maintaining race horses. Suppose if I have a stud farm in Chennai, I have stud farm in Bangalore. Bangalore is getting profits. Chennai stud farm, I'm making losses. I can set off these two. So these are the restrictions within the head of income. Now suppose I have a normal business. From that I have a loss and I have a speculation profit. Can I set off? Yes. Sir, you just said it is not possible. No, I said speculation loss cannot be set off with others. I did not tell other businesses loss can be set off, cannot be set off. No, I did not tell. So the restriction is only for speculation loss, specified business loss, long-term capital loss, loss from owning and maintaining race horses. These four items, these four losses can only be set off against these four profits. Remaining losses I can set off with other profit, other losses. I can remaining losses I can set off with other profits also. If I have a profit in speculation and loss in non-speculation, non-specified activity, can I set off? Yes, because there is no restriction for this loss. I have a short-term capital loss. Can I set off with long-term capital gain? Is there any restriction for short-term capital loss? No, so I can set off. I have a loss in other sources. Can I set off with owning and maintaining race horses profit? Is there any restriction for this loss? No restriction, so can set off. Over. So that is intra-head set off. Now, first, when we are computing problems, first we should apply intra-head set off. Still you have a loss. Then you can set off that loss with other heads of income. You can set off the loss with what? Other heads of income. Which losses? Other than the four which we discussed. Because those four items are untouchable. You can't touch them at all. Getting the point? Long-term capital loss, loss from speculation, loss from specified business, loss from owning and maintaining race horses. These losses can only be set off against these respective incomes. Getting the point? So they can't be set off with other heads also. If I have some other loss in the head of income, what about that loss? Can I set off with other heads of income? Yes, you can absolutely set off. But there are certain additional restrictions. House property loss can be set off against other heads of income only up to 2 lakhs. Only up to how much? 2 lakhs. Suppose if I have a house property loss, head of income itself is total loss. 2.5, 3 lakh loss is there. I can set off with other heads. But maximum how much? Up to 2 lakhs only. Now when you are setting off inter head, Interhead, no. First, no, set off against long-term capital gain. Set off against short-term capital gain 111A. Then set off against long-term capital gain 112A. So 112, which is taxable at 20%, which is taxable at 15%, which is taxable at 10%. So when you are having a loss, you are having these gains. First set off against these gains. Getting the point. Suppose no, you are a company, your normal rates of tax, normal income, PGBP income, normal rates of tax is 30%. In that case, set up with normal rates of tax. Why? Suppose if you have a loss, a company is there, it has a loss in one head. So it has a profit in BGBP, it has a profit in long-term capital gain. Long-term capital gain for the company is taxable at 20%, whereas normal profit business is taxable at 30%. So if I set up this loss against business or against capital gain, which is beneficial, I will set off with business because my tax liability will come down. Able to understand. So whichever income is taxed at higher rate, against that set up this loss. So that's the logic. Getting it? Fine. So a house property loss cannot be set off against other heads of income beyond 2 lakhs. You can set off up to 2 lakhs against any head of income. You can set off against salary, you can set off against PGBP, you can set off against capital gains, you can set off against other sources. But remember, if other sources income consists of winnings and lotteries and card games like that, against that you can't set off. Getting it? As per 115BB, winnings, lotteries, card games, puzzles, whatever it is straight away taxable at gross 30% rate. No set off is permitted. No deduction from that is permitted. No expenditure can be claimed. No loss on that source can be considered. That is 115BB section clearly says that. Are you clear? Next. Now there is another one. Loss under the head PGBP. Loss under the head of income. Which head of income? PGBP. Loss under the head PGBP means what? It may be normal business loss, it may be depreciation loss, it may be loss related to capital expenditure on scientific research, it may be loss related to capital expenditure on family planning. These all come under losses under the head PGBP. Loss under the head PGBP can be set off with any head of income except salaries. So with the salaries head of income, PGBP loss cannot be set off. PGBP is head of income related loss. It may be depreciation loss, it may be it may be normal business loss, whatever. You cannot set off with salaries head of income. But the loss under the head capital gains, loss under the head itself capital gains cannot be set off with any head of income, cannot be set off with any head, which means if I have a losses within the head capital gain, I have to set up only with capital gains. Further, long-term capital loss can be set up only with long-term capital gain. Short-term capital loss, I can set off with long-term capital gain, I can set off with short-term capital gain. Still I have a short-term capital loss. Can I set off with other heads of income? No, you cannot. And further, remember, whether it is intra-head or inter-head, suppose if I have income, getting it from an exempted source, suppose I'm doing agriculture activity, from that I made a loss. Can I set off with other heads of income? No. Agriculture income, if you get positive, it's exempted, right? Same way, if you have a loss in agriculture, that loss has to be ignored. So loss from an exempted source has to be ignored. Getting the point? Fine, sir. Understood section 70, understood section 71. So summary, what is the story? Loss from speculation business can be set off only with speculation income. Loss from specified business can be set off only with specified business. Loss from long-term capital loss can be set off only with long-term capital gain. Loss from activity of owning and maintaining race horses can be set off only with income from owning and maintaining race horses. Loss under the head house property can be set off with other heads of income up to maximum of 2 lakh. Loss under the head PGBP cannot be set off with salaries. Loss under the head capital gains cannot be set off with other heads of incomes. That's it. And loss from an exempted source has to be ignored. Listen to this day before exam. Believe me, you will definitely, everything will go into your mind. You will never do a mistake. Fine. Next. Now, sir, I applied within the head set off. Then I have still loss. I applied set off with other heads also. Still I have a loss. What should I do? Carry forward. What you should do? Carry forward. Now, section 71B, house property loss after set off up to 2 lakhs with other heads. Still you have a loss. Carry forward for 8 assessment years after the assessment year for which you got the loss. 72, sir, I have a normal business, sir. Not a speculation, not a specified. I have a loss from normal business. I set up with other heads except salary. Still I have a loss. What should I do? Carry forward for 8 assessment years. Sir, I have speculation loss. Carry forward for 4 assessment years. Sir, I have a specified business loss. I'm doing a specified business, 14 businesses. I'm doing that business and I have a loss. What should I do? Carry forward for infinite number of years, no time limit. Sir, I have capital losses. Sir, I have a long-term capital loss, sir. I can set up only with gain, right? But I don't have gain. What should I do? Carry forward for 8 years. Sir, I have a short-term capital loss, sir. I set it off with long-term capital gain, short-term capital gain, all that. Still I have a loss. What should I do? Carry forward for 8 years, 74 years. Sir, I'm having a business called owning and maintaining racehorses. From that activity, I got a loss. What should I do? Carry forward for 4 assessment years. Carry forward. Very simple. Now, in order to carry forward these losses, except 71B, in order to carry forward these losses, section 80 says you must file IT return. Very simple. Now you need to understand what is business loss, what is unabsorbed depreciation loss correctly. Now, when you are calculating loss under the head PGBP, first you compute income from business or profession, right? You compute it. How do you compute income from business or profession? All incomes minus all deductions, disallowances and all, you just apply. Like you start with net profit, add disallowances, less further deductions, anything. Now you will have a profit, right? For that profit, as per PGBP provision, first compute profit or loss. Suppose you computed there is a loss. There is a loss. This entire loss is not business loss. To this, add back depreciation claimed under section 32. Okay, added back. To that, add back deduction claimed under section 35 for capital expenditure on scientific research. Add back because you claim a deduction already. Suppose you did not claim a deduction for depreciation. You did not claim deduction for capital expenditure on scientific research or capital expenditure on family planning. Before claiming these three deductions, getting it? What is PGBP income calculate? Or if at all you calculated as per standard procedure PGBP result, you have a loss. To that, already you reduced depreciation under 32, right? Depreciation, additional depreciation, all that. Already you reduced capital expenditure on scientific research, right? Already you reduced deduction under section 36 for family planning, capital expenditure, right? Add back. Now, after adding back 3 also, if still there is a loss, this loss is only called as business loss within the meaning of section 72. Only this loss is called as business loss. Now in 72, I told, right, business loss can be carried forwarded for 8 years. That 8 years point will apply only for this loss. Suppose now, which means before claiming deduction, deduction for depreciation, before claiming deduction for scientific research and family planning capital expenditures, you still have a loss. This is business loss, carry forward for 8 years. And these items, remember, what is it? The depreciation, the capital expenditure, scientific research and family planning, these expenditure, the business profits are not sufficient to absorb these expenditure. Therefore, unabsorbed depreciation, unabsorbed capital expenditure on scientific research, unabsorbed capital expenditure on family planning, you can carry forward how many? Infinite, no time limit. Are you clear? And once you carry forward, what you should do? For all carry forward losses, there is a restriction. What? Once you carry forward a loss under one head of income, next year, what is it? It's a brought forward loss. Suppose I have a brought forward house property loss. Generally, current year we have a house property loss. What can I do? I can set off with other heads. Still I can carry forward. Like that, I brought forwarded one loss. Now, can I set up the brought forward house property loss with other heads? Not at all. Once you brought forward a loss under a particular head of income, that loss can be set off only with the same head of income, which means section 70 and 71 talks about only current year loss, current year losses, current year intra-head loss, current year inter-head set off, current year losses only you can set off with other heads. What about brought forward losses? Brought forward losses you cannot set off with other heads of income. However, brought forward losses, which losses? Unabsorbed depreciation, unabsorbed capital expenditure on scientific research and family planning, these can be set off with other heads of income except salaries. Unabsorbed depreciation, unabsorbed capital expenditure on scientific research, unabsorbed capital expenditure on family planning, these losses can be set off with other heads except salaries. I hope I have covered all the points. That's it. Set off and carry forward chapter revision is over. Entire this theory you can find here. So in the book, very clearly, very structuredly we have arranged all the provisions, everything. Neatly we have made it. Getting it for better understanding. That's it. So with this, set off and carry forward provision is completed. Revision is completed. I hope you are confident. So let's continue. Test your knowledge questions. Approximately 10 were there here. So if I solve these 10 also, in set off and carry forward alone, we have solved 15 questions. Fine, anyhow, straight away let's solve. So compute gross total income of Mr. F for assessment year 23-24 from the information given below. Okay. So let's, as usual, same method. So first they have given income from house property, which is already computed. So no more further adjustments. Getting it? Yeah, sorry. Alexa got played suddenly. Yeah. So income from house property computed, which is 1,25,000. So first income from house property, how much it is? 1,25,000. Okay. Then income from business, and see, before providing for depreciation, that is 1,35,000. And definitely, if at all this is a profit, and see the depreciation, current year depreciation, how much it is? 26. So we can provide, no. So 1,25,000 over, and PGBP income before depreciation is how much it is? 1,35,000 profit. 1,35,000 minus current year depreciation, how much it is? 26,000. So these two also we have considered. So whatever I am considering here, I am just striking it off, just that, so that we will not repeatedly take it. Fine. Next. So what is the net PGBP income after current year depreciation minus 26,000 is equal to 1,09,000. Then short-term capital gains on sale of unlisted shares. Okay, short-term capital gain on sale of unlisted shares, how much it is? 56,000. Fine. So 56,000. Okay. Then we have a long-term capital loss, which is brought forward from previous assessment year, and during this year, is there any long-term capital gain anywhere? Nothing. So this will be carry forwarded again. So no treatment for this. In this year problem, no treatment, because in this year we don't have any long-term capital gain. So we can't set up this loss. Getting it? So this we will be carry forwarded. So no adjustment on that. Income from tea business. You know, in PGBP, agriculture topic I kept pending. In that, one of the topic is growing and manufacturing tea powder. Tea. In that, no, we have not discussed, but I'm just telling you. In this, only 40% is treated as taxable business income. Remaining 60% is treated as agricultural income. So why? What is the reason? We will discuss an agricultural income topic completely. Now, in this, how much is taxable? Only 40% is taxable. So out of 1,20,000, tea business, how much is taxable? 40% of 1.2 lakh, which is 48,000. Correct? Next, dividend from Indian company carrying on agricultural operations. Even if the company carrying agriculture, doesn't matter. Dividend received from companies taxable under other sources. So now income from other sources. This is capital gains. This is PGBP, and this is house property. Now other sources. What is the income that we have? Dividend income. How much is the dividend income? 80,000 rupees. 80,000 rupees. Okay. Fine. We have listed out all. Now still what else is there? One more thing is there. You see, brought forward loss. Brought forward business loss belonging to 6 years ago. We can carry forward up to 8 years. So this is 7 years. 6 years back loss means right now, which is here? 7th year this might be. So which can be used for Setoff, 45,000. Now PGBP, how much it is totally? 109,000 plus 48,000. How much until now? 1,57,000 minus 45,000 I can set off, right? So brought forward business loss, so I can set off. So this is also considered. So all the amounts are considered. So what is the net business income? Minus this one. So 1,12,000 is net business income. Net house property income, by the way, income from house property, yeah, positive. Income from business, okay, positive, that we considered. Everything is considered by us. Getting it? Now, so let us total it now. So what are all the items that we have to total? 125, 112, 56, 80. I hope my answer is correct. Total 3,73,000. The total income is gross total income is 3,73,000. Gross total income means before reducing chapter 6A deductions, total of all heads of income plus clubbing provisions you apply plus set off and carry forward you do. After that, whatever the figure is there, that's called gross total income. From that we claim chapter 6A deductions, and then we get total income. On that only we compute tax. So 373. Let's see the answer. Correct only. 3,73,000, which is correct answer. So now, by the way, in this, what are all the consequences further? What are the consequences further? So this 90,000 rupees is there, na? Capital loss. This we will carry forward. This we will carry forward, and that's it. Only 90,000 will be carried forwarded further. That you need to write a note point. So long-term capital loss cannot be set off against short-term capital gain, because it can only be set off against long-term capital gain, and hence this long-term capital loss, which is brought forwarded, will be carried forwarded to the next year. That's it. Next. So that's question number 1. Next, question number 2. So until here only the question is fine. Income from salary computed, fine. So first getting it salary income. So income from salary computed, how much it is? 3 lakh. So getting it, 3 amount columns we will maintain. That's it. So within the head we will do here, within the head. So intra head set off we will do within the head. Inter head set off we will do here. So final outcome we will come here. So that's how you can do. Fine. Loss from let out property minus 40,000. Fine. So let us not consider right now. Losses and all we consider later. So by the way, so income is considered now. Fine. Income from sugar business. This is PGBP. So PGBP, getting it, sugar business. Sugar. See, nothing is mentioned. It is not a specified business. You remember, I think business number 11, income developing and building and operating a warehousing facility for storage of sugar. So that's a specified business under 35 AD, but they didn't mention like that, storage of sugar and all. They just mentioned sugar business. So it is not a specified business. So we assume that it is not a storage of sugar business. So it is not 35 AD. Fine. That is how much? 50,000. Fine. Next. So this is considered. Short-term capital loss. These are all losses. Losses we will discuss at a time later. Long-term capital gain. How much? 40,000. So capital gains. Long-term capital gain. How much? 40,000. Okay. Then we have a dividend income which is 5,000. So other sources. Dividend income. How much is the dividend income? 5,000. Okay. So this also we considered. Income received from lottery. 50,000. Remember, lottery income, no question of set off. So directly outer column we will put 50,000. Straight away we will put outer column 50,000. So because on this you can't use any set off. And remember, from lottery you have 50,000. From card game you have 6,000. Sometimes in exam, here they said net gross, right? Sometimes in exam they will give you 35,000 here and they'll put net here. Instead of gross they'll put net and they'll give you net gain 35,000. Net means 50,000 minus 30%. That is net. 30% is tedious. Remember, if I win 50,000 rupees lottery, they deducted 15,000 tax and then paid me balance amount only. But what is my income? 50,000 is my income. So if they give lottery income net, that amount divided by 30% is a tedious rate on the lottery. Sir, what is this tedious rate? All that we will discuss in tedious chapter. Getting it? So that's it. So sometimes that will be, but anyhow here they have given gross only. So winning from card games, gross only they have given. So 50 plus 6. So both to put together, winning lottery and card game, both put together 56,000. How much is that? 56,000. Because on this no adjustments further. Next. Agriculture income. Exempt. Agriculture income is not at all taxable. It is exempt under 10 clause 1. Then we have short-term capital loss, bank fixed deposit. Okay, we have interest bank deposit also. So interest from banks, how much it is? 5,000 again. Okay. So interest from bank 5,000. Now let us apply the losses. Now we have house property loss. What is loss? House property. Now house property loss I can set off against salary, I can set off against PGBP, I can set off against capital gains, all that. Now first of all, do we have any capital gains here? So you see here this amount, this one. I have a loss. So yeah, capital gain is there. But you see already long-term capital loss is there. So is there any long-term capital gain is there? Short-term capital loss is there. So first what I will do is short-term capital loss I will set off here. Short-term capital loss I will set off. Up to how much? 40,000 I will set off. Actually 60,000 is there. But only 40,000 I can set off. Remaining 20 I will carry forward. So set off both. So capital gains net result is what? 0. So this we considered. Short-term capital loss we considered. How much we set off with long-term capital gain? 40,000 we set off with long-term capital gain. Balance 20 we will carry forward. We will carry forward. So now capital gains head of income will become 0. Final result over. Next. Then we have, okay, first let us see PGBP. Loss from iron ore business. How much it is? 1,20,000. Iron ore business. Okay. Now how much we have business income? Sugar business we have 50,000. Then we have any other business income? No. Fine. So minus iron ore business. Iron ore. How much is the loss? 1,20,000. So up to 50,000 I can set off, right? So what is my net PGBP income? 0. So still loss is how much totally? 1,20,000. So 70,000 what I will carry forward. Okay. So this also considered. Now short-term capital loss we have, which is 10,000 current year. Current year short-term capital loss how much? 10,000. But already capital gains completely set off is over. Complete set off is over. Getting the point? So this I will simply carry forward. Simply I will carry forward. Then we have, so this I will carry forward. This I will carry forward because we can't set off with other heads. So because no, already one short term capital loss we set off here. Here itself 20,000 minus is that which we carry forwarded. So this also we will carry forward. Next we have house property income. This I can set off only with the salary minus house property. What? How much is that? 40,000. Remember, if house property loss is more than 2, only up to 2 we can set off. But since it is 40, entire 40 we can set off. So 2,60,000 is the net result. So with this one. So fine, all points are we considered everything. Yeah, fine, very good. So now let us total the outer column itself. So 2,60,000, 56,000. 2,60,000 plus okay, interest income is there. No, these two also 10,000. So 2,60,000 plus 56,000 plus 10,000. 3,26,000 is the answer. I don't know whether it is correct or not. I hope so because we did correct process. Nah, if the process is correct, answer should be correct. 3,26,000 is the answer. Thank God. 3,26,000. So the short term capital loss totally we will be carry forwarding 30,000. Iron ore business loss 70,000 we will be carry forwarding. That we already seen. That we have already discussed. Then question number 3. You see question number 3 almost so big. Fine. Question number 3. Mr. Batra furnishes the following information. Okay. So they have given short term capital gain. So they have given capital gains income, which is short term capital gain. How much is that? 1,40,000. 1,40,000. Okay. Loss from speculative business. That's a loss, no? This is a loss. So we will consider later. This we considered. Long-term capital gain on sale of land. Long-term capital gain on sale of land. How much is that? 30,000. First time listing out incomes, you see. So this also we consider now. Long-term capital loss on sale of unlisted shares. Okay, this is a loss. Losses and all we consider later. Fine. So this is a loss. So this is a loss and this is a loss. Fine. Income from business of textile after depreciation 50,000. Since I have given after depreciation, so PGBP. Okay. Textile business. How much is that? 50,000. Okay. So this we considered. Income from owning and maintaining race horses, which is other sources. Race horses. How much is the amount? 15,000. Then, so which we considered. Income from salary. How much is the salary income? So salary income is how much, which is they have given computed amount. Suppose no, if they say gross salary 1 lakh, no. Suppose if they say gross salary 1 lakh, they have not given income from salary, they have given gross salary 1 lakh. 50,000 you claim deduction, then balance is income from salary under head of income. Please be clear. So that way also they can modify. Since it is computed, we will take 1 lakh. Fine. Next, so this we considered. Loss from house property 40. So now 3 losses we have. Further, they have given losses from owning and maintaining race horses brought forward. Now brought forward losses. Now we have current year losses, then further losses. Fine. First, no, loss from house property is there. Then long-term capital loss is there. Loss from speculation business is there. Remember, loss from speculation business can be carry forwarded, can be set up only with speculation. Here there is no speculation income, so I will carry forward. This I will carry forward. Correct? Fine. So that is over. Long-term capital loss on sale of shares, which it can be set up only against long-term capital gain. So how much is long-term capital gain? 30 only. So entire 30 is over. Yes or no? Still how much long-term capital gain is there? How much loss? 70,000 will be carry forwarded here. Yes or no? Here it is 70,000 will be carry forwarded. Here entire 60,000 will be carry forwarded. So here 70. So this 1 lakh also we adjusted. Only 30 we could set off. So 0. Fine. Now we still have short-term capital gain. Remember here in this. Then we have loss from house property. Now we have a short-term capital gain of 1,40,000. Just a minute. We have a short-term capital gain of 1,40,000. So now, and we have house property loss, right? House property loss, no, I can set off here, I can set off here also, both. So let us assume I will set off against salaries, or I will set off against capital gain minus house property loss, whichever is beneficial. House property loss I will set off. How much? Loss from house property 40,000. So what is the balance income? Balance short-term capital gain 1 lakh. Balance long-term capital gain 0. Sometimes no. Suppose no, house property loss 40,000 is there. And let us assume here it is short-term capital gain 111A. Let us assume. Here salary income is there. Now if I apply Setoff and carry forward total tax rate, no, SSC total income is less than 5 lakhs. Normally, what is the rate of tax? 5%. But if it is short-term capital gain 111A, what is the rate of tax? 15%. Now, if I have a loss, I can set off this loss against normal income, which is taxable at 5% slab rate, short-term capital gain, which is taxable at 15% flat rate. If I set up this loss with which gain, it will be beneficial. Which income, if I set up, it will be beneficial. If I set up this loss with 5% taxable income, or if I set up this loss with 15% tax rate income, which is better? 15% tax rate is better. But here they have not given 111A, because it's not 111A, right? Short-term capital gain, they simply said, which is not 111A, general short-term capital gain. So this is normal rates of tax, this is normal rate. So anywhere I can set off. Suppose if it is taxable at 15%, 20% like that, and this is taxable at 5% like that. Against what I can set off this loss? Against that income which is taxable at higher rate. So use that. So fine. So I'm just telling you an alternative. Getting it? For that also in exam marks will be there. Fine, that is also over. So loss from house property, we set off against capital gain. Then loss from owning and maintaining race horses, 25,000. So race horses, brought forward loss. Which year it belongs to? 2021. So now it can be carry forward 21, 22. 22, 23, 23, 24. Oh my god, this is third year already. So which means only one more year is there. Fine, 25,000 is there. Whereas here income is 15,000. So up to 15 I can set off. So which means 10,000 will be carry forwarded to assessment year 24, 25, which is the last year for that loss. Fine. So net result is 0. Now brought forward loss from business of textile 60,000. Loss pertains to 15, 16 assessment year. Oh my god. So 16, 17, 17, 18, 18, 19, 19, 20, 20, 21, 22, 23, 23, 24. So this is first year. So that is 0. 1, 2, 3, 4, 5, 6, 7. Thank god we are in the 7th assessment year. So this is eligible for set off 60,000. Now brought forward loss. So I can set off here. Brought forward business loss. Brought forward business loss, how much? 60,000, but we have only 50. So only 50 we can set off. So balance 10,000. So balance 10,000 we can carry forward to next 1 year only, because that's the last year. Assessment year 24, 25 is the last year. Fine. So 0. Now, so this final output is 0. This final output is 0. This output is 0. Whereas here it is 1 lakh. How much is the total income? 2 lakhs is the total income. Gross total income is 2 lakhs. I hope you understood how I solved. So my process is correct? Yes, absolutely. If you follow the process rightly in the way which I tell, getting it, which exactly you will get correct answer. 100% damn sure correct answer. So what are the losses? Speculation of 60,000 to be carry forwarded. Long-term capital loss to be carry forwarded. Income from owning and maintaining horses 10,000 to be carry forwarded. That's it. Next. Illustration number 4. I hope you are making a notes of it, or if not, anyhow solution is given. My notes is not required. Fine. Next. Mr. A furnishes you the following information for the year 31st March 2023. Okay. Income from plying of vehicles computed as per the books. So as per the books, 3,20,000 is the income. He owned 5 goods carriage vehicles throughout the year. But fine, let us compute. So income from plying. See, they have given vehicles information, means they are asking you to compute even presumptive basis also. Let us see the entire question. Okay, don't worry. So 3,20,000. First let us compute normally, not presumptive. Whatever they have given based on that. Income from retail trade garment computed as per books. So sales data they have given. And Mr. A, he declared income on presumptive basis under 44 AD for the first time in assessment year 22-23. So last assessment year he declared. Continuously 5 assessment years he should follow presumptive basis, right? Assume 10% of the turnover was received in cash. Okay, 90% is received in other than cash. On the 90% of the turnover, what is presumptive income? 66%. Income itself is 6%. On the 10% turnover, what is the presumptive income? 8%. So because he received through Eken Poiche, all that fine. That is 7,50,000. Normal rates I'll compute it. Let me compute normally. So income from trading of garments, 7,50,000. Okay. And he has a brought forward depreciation. Okay, unabsorbed depreciation. I can set off no, because unabsorbed depreciation is discussed under 32 subsection 2. I can set off it against current year business income. How much it is? 1 lakh. So how much it is? 1 lakh. So net result is what? 7,50,000 plus 3,20,000 minus 1 lakh. So 9,70,000 it net result. But remember, this SS is falling presumptive basis, which means we have to compute set off and carry forward gross total income on presumptive basis. Let us compute under presumptive basis. So presumptive basis of calculation. So plying of vehicles. And remember, plying of vehicles means, once again I'll restart this. Income from plying of vehicles, he owns 5 light good vehicles throughout the year. So entire 12 months, 5 light good vehicles were there. For light good vehicle, what's the presumptive income? 7,500 per month or part of a month. How much is that? So 12 multiplied by 5 into 7,500. How much? 4,50,000 is presumptive income. Okay. Then his turnover from retail business is how much? Retail business. Non-cash turnover. Cash turnover is 10% ma. So this is total turnover 1,35,70,000 multiplied by 10%. So 13,57,000. So this is cash turnover divided by 10 into 90%. 1,22,13,000. This is non-cash. On this 6% is presumptive income. On this 8% is presumptive income. 1,22,13,000 into 6%. How much it is? 7,32,780. Now 1,35,000 into 13,57,000 into 8%. 1,08,560. So total PGBP business income is how much? 4,50,000 plus 732. 4,50,000 plus 7,32,780 plus 108,560 is equal to 12,91,340. This is presumptive income. Now remember. Now presumptive income we compute. Now brought forward depreciation loss is how much? 1 lakh. You know what? If you remember presumptive taxation 44AD, 44A, all the sections, all the deductions under 30 to 38, we assume that we have deemed to have been allowed. Depreciation, everything, we assume that it is allowed already. Tell me, when we assume that all the deductions, including depreciation, is deemed to have been already claimed while calculating presumptive income, do we once again consider brought forward depreciation loss? But if brought forward business loss is there, not depreciation loss, that we can set off. But brought forward depreciation loss, this comes under section 32. When we calculate income under presumptive taxation, all the deductions under 30 to 38 are deemed to have been allowed. This is the final result under PGBP. That's it. So 12,91,340. So this is the income. Now compute taxable income of A and tax liability. Okay, we will see tax liability only for this. So what is Mr. A? What is his A? Nothing is given. So tax liability. Getting it? So how do we compute? 12,91,340 minus 10 lakhs. So this entire excess amount 2,91,000 is taxable at 30%. Up to 10 lakh, 1,12,500. So 291,340 multiplied by 3% is 1,12,500 plus 4%. 2,07,898. This is the tax liability. So presumptive income, right? 2,07,900. That's what we computed, no? 898. Nearest 10 rupees they will round off. So 900. That's it. So our answer is absolutely correct. Suppose if at all he does not follow presumptive taxation, 9,70,000 is his income. So that's what we also computed. Without presumptive taxation, what is his income? 9,70,000. That's it. Next. Question number 5. Okay, fine. Question number 5, loss from speculation. Since it's a loss, we will discuss losses later. Income from speculation business, how much it is? 5,000. So PGBP, speculation income. How much it is? 5,000. Okay. Loss from specified, this is loss again. Income from salary computed, 3 lakhs. How much it is? 3 lakhs. Okay. Loss from let out. So let us not consider. Remember the loss from let out property. House property loss is 2.5. When I set off with other head of income, how much I can set off? 2 lakhs only I can set off. 50,000 I will carry forward. Remember that point. Income from trading business. Okay. Trading income. How much is that income? 45,000. So I will strike this because I considered. Long-term capital gain on sale of urban land. Capital gains. Long-term capital gain, that too is a land. Getting it. How much it is? 2 lakhs. So I will strike off. Then long-term capital loss. This is loss. So this I will keep pending. Getting it. So loss. Because losses and all we consider. Again, long-term capital loss on sale of listed securities, STT paid at the time of acquisition. This is 112A loss. Remember, not gain, loss. We can consider, no. How much is that? 1 lakh, 1 or 2,000, we'll consider later. Loss from owning and maintaining resources pertaining to last year, last before assessment year. But this year, do we have any such income? No. So this we will simply again carry forward. Brought forward loss from trading business 5,000 related to assessment year 18-19. So since right now we are in 8th year, this brought forward trading loss I can set off. So I can set off brought forward trading loss. Okay. So this I can set off. So this is also over. This we will carry forward simply. So treatment is over. We considered. Now let us look at the losses. Now we have loss from speculative business. We have loss from specified business. We know very well. Loss from specified business we can carry forward. I mean, we can only set off with the specified business income, but here specified business income is not given. Therefore, this will be carry forwarded. And here 2,000 will be carry forwarded. That's it. Now, loss from house property 50,000 is carry forwarded, but 2 lakhs we can set off. Fine. Let's come to that. Later. Fine. So now we have speculation business loss, right? Let us strike it off. So how much we have speculation income? 5,000. So 5,000 speculation loss is there, no? That we can set off. So speculation in loss from one speculation business is 25, whereas income from another speculation 5. So these two I can set off. Yes or no? The effect is 0. Whereas here the effect is 40,000. Remember, remaining speculation loss 20,000 rupees I will carry forward. Correct? So specified business loss 20,000 I will carry forward. Then salary over. Loss from house property. So loss from house property, no, I will set off against salary, and I have capital gain also. Fine. First I will say capital gains. Long-term capital gain 2 lakhs. I already added here. Now we have long-term capital loss on sale of shares, STT not paid 75,000. Long-term capital loss on listed shares 1 or 2. 2 losses we have. Both the losses we can set off now. And 1 or 2,000 both I can set off. Yes or no? So 2 lakhs minus 1 or 2,000 minus 75,000. What is the balance capital gain? 23,000 is the balance capital gain. Okay. Now you see. So this also I adjusted. Now I have still 2,50,000 house property loss. Remember, this I can set up with other heads up to 2 lakhs only. Now I have other heads of income. PGBP income is there. Salary is there. Capital gain is there. Remember, these two incomes, no, anyhow less than 5 lakhs, taxable at 5% slab rate. Whereas long-term capital gain is taxable at 20%. So now house property loss up to 2 lakhs I can set off. No. Here I will set off 23,000. So capital gain income will become 0. So there is no income which is taxable at 20%. So I set it off. Now still out of 2 lakh, 23,000 is there na? 1,77,000 is there. That 177 against what I can use? Against salaries I can set off happily. So what is the balance salary income? 1,23,000 is the balance salary income. Balance PGBP income is 40,000. Getting it? I think all other adjustments we have done, right? So 2.5 also we considered. Remember, in this 50,000 will be carry forwarded. So speculation loss 20 carry forwarded, specified business loss 20 carry forwarded, and house property loss 50 to be carry forwarded. And here 2,000 rupees horses related thing will be carry for 4 carry forward of losses. Fine, that's it. So now, so 40,000 is taxable, 123. So 40,000 plus 123. Here it becomes 0. So 1,63,000 is the final answer. I hope I'm correct. I hope you also solved along with me, analyzed along with me. I hope you also understood the answer. Now let's look at Thank God, 1,63,000. So there are 4 losses to be carry forwarded. Yes, house property to be carry forwarded. Items eligible for carry forward. Speculation loss. Specified income. Yes, our carry forward provision is also correct. Fine. Here we have information. 6th question. Mr. Garg, a resident individual, furnishes the following particulars of his income and other details. So salary income is there, which is already computed. Salary income. Shall I do one thing? I'll explain directly there itself. Okay. Salary income. Okay. Tick. Income from business, positive, tick. Long-term capital gain, positive, tick. Loss. Let us consider losses later. Then they have unabsorbed depreciation brought forward. So previous year depreciation 11,000. Loss from speculation. Now is there any speculation income here? Nothing. So this will be carry forwarded again. Short-term capital loss 9,800. Is there any gains here? Capital gain? Yes. So here in the current year we have a capital gain long-term. Getting it? Whereas short-term capital loss is there. So strike off. Getting it? This 9,800 I can set off here. So what is the net long-term capital gain? 1,000 rupees only still we have. Fine. Then unabsorbed depreciation 11. By the way, loss on maintenance of racehorses only can be set off against income from racehorses. So 15,000 to be carry forwarded. This is balance gain. This is not carry forward. Balance gain. Loss from gambling. Winning from gambling is taxable straight by 30%. Any loss on that gambling, ignore. Because in respect of winning, gambling and all, loss and all, question is not permitted. The question of loss itself is not existing in income tax law. So loss from race horses maintenance is permitted. Loss from horse races, that is to be ignored. If I participate in horse race and get a loss, ignore, because that's a gambling related loss. Winnings related loss. For winnings, no horse races, no, if I spend any money, nothing is considered. And if I get any winning, entire amount is taxable at flat 30%, no deduction. Can I set off any loss? Against the winning? Nothing. Can I claim chapter 6A deductions from the winnings? Nothing. If you get any winning, fully taxable at 30. If you have a loss, ignore. That's the treatment of income tax department on winning related things. Fine. So salary we considered, income from business we considered. This we adjusted in 1,000 rupees balance amount. This we have decided to carry forward. This we will ignore. Now unabsorbed depreciation. Speculation business we simply had to carry forward. Short-term capital loss already we adjusted set off. Now unabsorbed depreciation is there. Unabsorbed depreciation, what we will do? It will be set off against business. So income from business is how much? 66 is there. Here unabsorbed depreciation 11,000 you reduce. So what is the balance amount? 66,000 minus 11,000. 55,000 is the balance amount. So balance amount taxable is 55,000. Balance capital gain taxable is 1,000. Here it is 1,000. Income from salary taxable is balance 15,000. These are all taxable items. So 15 plus 55 plus 1,000. 3 taxable. Remaining ignore. This is to be carried forward. This already set off is done. Okay, over answer is. So 55,000 plus 15,000 plus 1,000. 71,000 is the answer. These 3 only. After applying all the set off everything. That's it. Easy. Question number 7. Here chapter 6A, life insurance premium paid. This is actually ATC deduction, chapter 6A. If you don't understand, don't worry. Right now I will tell you what is the treatment, but in chapter 6A you will understand clearly. The following are details relating to Srivatsan, a resident Indian, aged 57, relating to the following year. Okay. Compute total income and eligible items eligible for carry forward, assuming that he is not having 115 ABC. Fine, we'll solve like this itself. So salary income, how much? 2,20,000. So 2,20,000. Loss from house property, let us consider. Loss from cloth business, let us consider. Income from speculation business, 30. How much? 30. Okay. Then loss from specified business. It can only be set off against specified business. So this amount will be carry forwarded. 20K will be carry forwarded. So this I will strike off. Long-term capital gain on sale of urban land, 2.5 lakh. Long-term capital gain, 2.5 lakh. So considered. Loss from card games. If winning is there, fully taxable. If any loss is there, ignore. This is ignore. Income from betting goes 45. Now you may have a doubt. Sir, these two can I set off? No. Each winning is treated as a separate thing. If at all there is a positive income, 30%. If it is a negative, ignore. That's the logic. Remember. 45, betting income. And remember, betting income is straight away taxable. No set off of loss is permitted against that. Then life insurance premium 10% paid. This we will discuss later. So betting income are considered. So that's it. Now let us look at losses. So this loss 25, 20 will be carried for loss from cloth business sum of 2,40,000. So here speculation business is there, no. Cloth business loss, I can set off. How much? 30,000. So what is the balance? 0. Still how much cloth business loss is there? Cloth business, how much is there actually loss? 240. 30 only we could set off. 2.4 lakh, only 30. Still how much balance is there? 2.1 lakh is there balance. That 2.1 lakh I can set off with capital gains. Na? Loss under the head, loss under one head of income can be set off with other heads except salary. So 2.1 lakh I will set off here. PGBP loss. So balance capital gain is what? 40,000. So this entire 240 we considered. Now loss from house property. Since it is less than 2 lakhs, I can set off with other heads. Straight away I will set off with the salaries. Getting not salary. Sorry. I have PGBP business, no. So 40 I will set off here. So house property loss. Remaining house property loss 1,50,000 I will set off here. Getting it? How much? 70,000 is a balance. This thing. Balance capital gain is 0. So balance salary income is, this is salary. This is PGBP 0. Capital gain 0. Betting 45. So now you see here. 70 plus 45, how much it is? 70,000 plus 45,000, how much it is? 1,15,000. 1,15,000 is the gross total income. Now they have given one adjustment. Insurance premium paid 10% of sum assured. 45,000 insurance premium is paid. So out of 1,15,000, betting income is how much? 45. So this is not eligible for any deduction and all. So 45,000 is flat taxable at 30%. Whereas what is the normal income? Salary income is there 70,000. This is eligible for chapter 6A. So 45,000 I will reduce. Insurance premium. So balance income is 25,000. Getting the point? So what is the total income? 25 plus 45. 70,000 is the net total income. That's it. So the answer. Hey, what happened? We got a different answer. We did right answer. Here they did wrong answer. They did wrong answer. We did right. What they did is technically correct, but beneficially it is not correct. Like I'll show you. Now, house property loss we have, right? House property loss. How much is the house property loss? 1,50,000 we set off with salary. 40,000 we set off with capital gain. Total 1.9 lakh. What they did, entire 1.9 they set off with salary. Because of that, salary income became how much? 30. Capital gain balance 40,000 as it is there. But in our answer, capital gain we made it 0. So first house property loss we set off against capital gains. Why we set off against capital gains? Capital gains, long-term capital gain. No, it is not eligible for chapter 6A. Chapter 6A deduction you will not get. So what they did, 30, they set off entire house property against what? They set off entire house property loss against salary. So balance 40,000 capital gain as it is there. And this is there. So 115. Now 115 you split into 3 parts. Winnings 45,000. Capital gain 40,000. Salary normal income is 30. On this chapter 6A you won't get 0. Whereas chapter 6A amount is how much? 45,000. Sorry. Deduction is how much actually? 45,000 they paid. But since normal income is 30, only normal income you can claim deduction. So remaining 85,000 is the total income. They did not opt. They did not choose beneficial provision. We have chosen beneficial provision and accordingly our answer is absolutely correct. Our answer is correct. Total income is 70. In our answer, we did set off in a logical and beneficial way. House property loss we have. Long-term capital gain 40 there. Short salary income is there. First I set off with long-term. 40 over. Entire long-term became 0. Then I will set off with salary. So balance salary became 70,000. Since the salary is 70, chapter 6A I can claim up to 70, but 45 only is there chapter 6A. So 45 we claimed. But in the answer which they did know, normal income is only 30 in the total income, gross total. So chapter 6A cannot be claimed more than 30. So they did right loan. See, that answer also right, our answer also right. But which is more beneficial for the SSC? Our approach is more beneficial for the SSC. So whenever there is a loss and you have a special rate of income, capital gains, and you have a normal rate of income, set off with normal income first. Special income first. Because generally long-term capital gain, short-term capital gain, 111A, long-term capital gain, 112A, they are all not eligible for Chapter 6A deduction. If Chapter 6A deduction is higher amount, no. If you set off these losses, normal income will be higher. Just this itself is best example. Watch the past 10 minutes or 5 minutes once again, this problem alone. So we did even more better answer than what they gave. Next. Can you solve these two questions at least on your own? Because mostly we have solved it now. These two questions just, okay. So you solve it on your own. So self-study, 8, 9, 10. Self-study. Here no one point is there. Here the person he is receiving share of profit from a partnership firm. He is receiving share of profit from a partnership firm. Remember, share of profit received from partnership firm is exempt under 10(2)(a). So we will not consider. That is one important point. That's it. In the next question, he has received salary as a partner from partnership firm 7,50,000. Next question, 9th question. The same was allowed to the firm. See, 7,50,000 remuneration is paid to partner, and firm also got deduction. Same was. Remember, how much salary received by working partner is taxable in his hands. How much ever allowed to the firm. I told this point very clearly. Whatever amount allowed to the firm as deduction, the same is taxable in the hands of the partner. Many things, this income is taxable under PGBP. For the partner it is PGBP. Though it's salary, partner is receiving from partnership. Employer-employer relationship is not there. Any salary interest received by a partner from partnership firm taxable under PGBP. Charging section 28 clause 5. Further, they have given this point. The same was allowed to the firm. What is the importance of this sentence? Allowed to the firm. If it is allowed to the firm, firm it is taxable. Suppose for firm 5 lakhs only allowed as deduction, but you received 7.5 lakh. For firm, as per income tax, 5 lakhs only expenditure. For you 5 lakhs only income, you may receive 750. That doesn't matter. Firm paid 750, you received 750. But how much firm got deduction? 5 only. For you also 5 only taxable. But here, entire 7.5 firm got deduction. So you received 7.5. Firm got deduction 7.5. So for you also 7.5 taxable. So that is the importance of this word. In exam, they may change this word. For the firm 5 lakhs only deduction allowed, whereas you received 750. But the firm 5 lakhs only deduction allowed. For you also 5 lakhs only taxable under PG. So the salary interest received by a partner from the partnership firm is taxable as income from PGBP to the extent allowed to the firm as deduction. So that's one important observation here. The sentence important observation. Then 10th question. Almost all these are similar to what we solved earlier. It's not a big deal. You can solve it. Please 8, 9, 10 you solve it on your own. Definitely you will get the answer. Okay. Same how I did same way you do it. 8th question alone I will explain, because brought forward loss, all that were given. 8th question I will explain. 9 and 10 you do on your own. 8th question. Mr. Rajat submits the following information for the financial year ending 31st March 2023. Decides compute the total income. What are the losses that can be carry forwarded? He has 2 houses. Income from house 1 after all deductions. 72,000 income is there. So house number 1 income how much? 72,000. Okay. House number 2 there is a loss. So loss we will consider later. So 72,000 income is over. But anyhow the current year loss, anyhow we have to apply intra-head set off. So 30,000 first I will have to apply the loss. So 42,000 is the balance income from house property. Now other heads related loss I can apply. Set off. Over. He has 3 proprietary businesses. 3 businesses. One is textile, another one chemical, another one leather. 3 businesses is having. So textile business. Current year loss. This is current year. Brought forward loss. So from textile business both are losses only. So let us not consider these 2. Chemical business. Discontinued. So no profit loss. Bad debts allowed earlier. Recovered during the year. So bad debts, earlier there is a bad debt and earlier it is allowed as deduction. Now it is recovered. 41 subsection 4. 35,000 rupees is taxable in the year in which it is recovered. In PGBP we have seen this point. So if bad debts is earlier allowed as deduction, now if it is recovered, it is taxable in the year in which it is recovered. To the extent allowed, it is taxable. Entire 35,000. So bad debts recovered. How much it is? For 35. So we considered 35. So 35,000. Fine, next. Brought forward business loss. Loss we will consider later. This is a loss. This is a loss. This is a loss. This is a loss. Leather business profit. Oh, so leather business profit how much? 1 lakh. Now you see total PGBP until now is 1 lakh 35,000 total income, only income. So leather business we consider. Share of profit in a firm which he is a partner. You know, if a partner, no, he will get interest income from the firm, salary from the firm, share of profit also. Share of profit is exempted. 10 subsection 2A, 10 clause 2A, share of profit received by a partner from the firm is exempt because firm will pay tax on the income. After paying tax, that is distributed to the partners. So that's exempt. Interest received by a partner, taxable in his hands. Salary received by a partner, taxable in his hands as business income. How much? Whatever firm got deduction, that much is taxed in the hands of the partner. So this is considered. Short-term capital gain. Short-term capital gain, how much it is? 60,000, fine. Next, long-term capital loss. It can be set up only against long-term capital gain. So obviously, carry forward because there is no long-term capital gain during there. So we will carry forward. Contribution to LIC. This is ATC deduction, chapter 6A. So this is over treatment. This will be carry forward. This is finally we will see. Now, what are all the losses still we have? Brought forward business loss we have. Current year loss. First we will set of current year loss. So textile business loss minus textile business loss. How much? 50,000. So what is the net result? 85,000. Okay. So textile business loss current year first we will set off. First current year set off we have to apply. After that brought forward losses we should set off. Now we have brought forward losses. What are the brought forward losses that we have? 95,000 belonging to 1819 assessment year. Another 50,000 belonging to 1920. Which is oldest loss? 1819 is oldest loss. First I will set off. So I have 85 only. So 85 I can set off. So what is the net PGBP income? 10. So out of this 95, 85 we set off. So another 10,000 to be carry forwarded. And whereas this 50,000 entirely to be carry forwarded. So 50,000 is also over. So 50,000 will be carry forwarded. 10,000 will be carry forwarded. 35,000 will be carry forwarded. Now what is my income? So P house property income 42,000. Short-term capital gain 60,000. By the way, here short-term capital gain, which gain we will see? Short-term capital gain they simply mentioned. They did not mention 111 and all. So it's a normal rates of tax. So what is the total income? 1,02,000 minus chapter 6 deduction. LIC premium paid how much? 10,000. How much it is? 10,000. So therefore, what is the net income? 92,000 is the net income. That's it. Very good. So 92,000 is the net income. So 9th question and 10th question solve on your own. In 9th question, one of the important point I have already told you. This is 7,50,000 is taxable as PGBP income, normal business PGBP income like that. Remaining you solve it on your own. So with this, set off and carry forward all the problems we have covered, all the theory we have thoroughly discussed. So take care, all the very best. So the next chapter is chapter 6A deductions. And I hope, by the way, one more thing. I hope you are very happy with clubbing provisions, capital gains, and set off and carry forward. Kindly reply me on Telegram. You can reach me on Telegram at caramharsha, RAMHARSHACA. Getting it? Or you can reach me on Telegram by searching my mobile number also 9700273087. And please give me your valuable feedback, how you are feeling about the tax classes and the all that completely comprehensively. And I definitely hope that you are learning new points and you're learning income tax in completely a new dimension. Okay, okay, take care. We'll continue in the next chapter. Directly we'll start chapter 6A deductions. Okay, take care. Yes, let's start chapter 6A deductions revision. Okay, so in this revision, I'm going to briefly explain you all the sections that are there in chapter 6A. The theme of each and every section, I'll clearly explain it to you. Plus, I will also explain you certain problems, some 5 to 6 problems I have solved, getting it, which are taken from our material. Nothing but they are there in the ICA material only. The same thing we copy paste. Getting it? Fine. So now, without any delay, so let's enter into chapter 6 deductions. These are the deductions which you are having. So entire ATC series, getting it? These are the sections. Actually, you see ATCCD 1, 1B and subsection 2. These three are single section only. But I intentionally wrote as a different sections because there is a very clear reason. And all these 4 sections, mediclaim, dependent with disability and disease. So all these sections we have given it one category. and all interest on loans. Getting it? Interest on education loan, interest on housing loan, interest on housing loan, interest on electric vehicle loan. Getting it? And all donations. Getting the point? All these items are what? Just a minute. All these items are donations. Getting it? Whereas this is regarding additional employee cost. And all these four are income based deductions. Remember, all these four are income based deductions. Whereas QQB, RRB, ATJJAA, these three sections are covered under heading C. These three sections are covered under heading C of chapter 6A. These three are covered under heading C. What do you mean by heading C? There are certain sections under chapter 6A, ATP, ATPA, ATLA, ATJJA, ATJJAA, ATI series, approximately some 14 to 15 sections were there. They all are coming under heading C of chapter 6A. Now, what is the condition? You know, under ATA, there is a section called ATA. What that section says is, in order to claim deduction under heading C related deductions, in order to claim deduction for heading C items, the SSC must file return of income on or before due date given under 139. On or before due date means what? If audit is applicable, 31st October. If audit is not applicable, the due date is 31st July. So on or before the due date for filing IT return, you must file the IT return. Only then you can claim these three sections, which I have highlighted in yellow color. Getting it? Only these three sections. For these three sections, if you want to claim deduction, you must file IT return on or before due date. Remember, under heading C, there are many sections. They are not in our syllabus. Only three sections related to heading C were at CA inter syllabus. Are you clear? Now, these four items again are income based deductions. Here you are getting some income. For the income which you are getting, we are giving you a deduction. So that is chapter 6A. Getting the point? Income based. Now, without any delay, let's continue a basic introduction to chapter 6A. Remember, long-term capital gain 112, long-term capital gain 112A, short-term capital gain 111A, and special income, winnings income and all 115BB. These items, they are not eligible for chapter 6A deductions. Suppose no. Like how to compute gross total income? Gross total income is nothing but 5 heads of incomes. So compute plus apply clubbing provision plus apply Setoff and carry forward provision. After setting of all this, if you are still having the income, no, that is called gross total income. And for the purpose of claiming chapter 6A deduction, this gross total income split into two parts. Like what? Incomes taxable at special rates. So LTCG 112, LTCG 112A, STCG 111A, any other special income like winnings 115B, 115BB, yes or no? So you keep these amounts separately. Then whatever balancing figure is there, no, those incomes are called as normal incomes. Normal income means what? The income that is taxable at the rate of tax applicable for the SSE generally. For individual slab rates, for a partnership firm flat 30%, for LLP flat 30%, for a company flat 30%, for a foreign company flat 40%. These incomes are taxable at normal rates. And remember, short-term capital gain, normal short-term capital gain other than 111A, it is taxable at normal rates. Now suppose this amount is, let us assume 5 lakhs. Now one of the condition in introduction to chapter 6A, what it says, the total chapter 6A deduction, the total of chapter 6A, all headings, heading A, heading B, heading C, all put together, the total of chapter 6A deductions cannot exceed 5 lakh. Maximum deduction cannot exceed gross total income. By claiming chapter 6A deductions, there cannot be loss. After claiming chapter 6A, it cannot be negative. The income cannot be negative. That's what the introduction basically to chapter 6A deductions. This is the basic introduction to chapter 6A. That is what covered in the introduction part of the entire chapter 6A. So this entire matter I have clearly given to you. Getting the point? So this entire I have explained you in this past 5 minutes. Now let's start each and every deduction. Now the first one is ATC. What is the first one? ATC. Getting it? Now, yeah. So the next deduction, first deduction is ATC. ATC, no, SSC is making certain investments. SSC is making certain savings for retirement purpose, all that. So there are approximately 23 deductions that are covered in CA Inter for ATC. But remember, we are not discussing all the 23 items. We will be discussing some 5 to 6 important items. Among that important items, one of the important item is, payment of life insurance premium. What is it? Life insurance premium paid. So deduction for life insurance premium. What are they saying? Suppose if at all paying any premium for life insurance premium of whom? Of self, SSE, spouse, any children. Remember, children can be dependent or non-dependent, and remember here parents are not covered, brother or sister is not covered. So if you are paying life insurance premium to you or spouse and children, only then you will get deduction under chapter 6A. Further, remember, life insurance premium can be paid in cash or can be paid in bank also, through check or through cash, both are allowed. And ATD, medical premium is there, it can only be paid by other than cash. Now premium, suppose here how much deduction you will get? Generally premium paid you will get deduction, but there is a limit. Maximum you cannot claim beyond the following limit. Suppose if the life insurance policy is issued, before 31st March 2012, actually in the problem they'll give you before 2003 also, that is irrelevant right now. So this is enough. Before, if at all the policy is taken before 1st April 2012, on or before 31st March or before 1st April 2012, then maximum deduction is 20% of sum assured only you will get deduction. Suppose if the policy is issued on or after 1st April 2012, then the deduction is, maximum deduction is 10% of sum assured. Suppose if the policy is issued on or after 1/4/2013 in respect of a person suffering from disability covered under 80DD or 80DDB disease, if at all, 80U they say. So if a person is suffering from disability given under 80U or suffering from a disease given under 80DDB, in respect of that person, if the policy is taken, that too when the policy should be taken after 2013, then the deduction is 15% of sum assured. This is the maximum deduction for premium paid for life insurance policy. Able to understand. Now you see, suppose for a person who is suffering from 80U disability or 80DDB disease, for him we have taken policy on 1/4/2012 or some 10th September 2012, nothing but before 2013, but after 2012 10% only applicable. Suppose if a policy is taken on or after 1/4/2013 on a normal person, he is not having 80U 80DDB, then 10% only. 15% is only for whom? If a policy is taken on 80U disabled person, 80DDB diseased person, the person suffering from disease. So for these two people, if the policy is taken, that too on or after 1/4/2013, then only 15% of sum assured criteria will be applicable. Are you clear? Now, in the ATC itself, they have covered about maturity proceeds of LIC also. Like in ATC, they didn't cover. Yet ATC only the discussion related to maturity point. Actually, the discussion related to maturity point is covered under 10 subsection 10D. Getting it? Or 10 clause 10D. This is actually exempted income chapter. But this point is mainly discussed under ATC section. ATC, along with ATC, it is discussed. So what 1010D says also, I'll tell you. Suppose, I am paying insurance premium and I'm claiming deduction every year under ATC, all that is fine. Now suddenly after 10 years or 15 years or 5 years, I received maturity amount. Now what is the tax treatment? Suppose if the insurance premium maturity amount is received because of the death of the person, on account of death of the person, if the nominee or legal heir is receiving the maturity amount, it is fully exempt. Suppose the SSC only receiving the maturity amount, SSC is alive, but policy became matured. Now this fellow is receiving maturity amount, bonus, sum assured, all that is getting. Getting the point? So much is getting. Now what is the tax treatment? The tax treatment is generally the premium received, the bonus amount, maturity amount received is taxable under income from other sources. However, under 10 clause 10D, in these three cases, the insurance maturity amount is exempted. If suppose if the policy is taken before 1/4/2003, any amount you receive later on, fully exempt. Suppose if the insurance policy is purchased, issued on or after 2003, 1st April, but before 1st April 2012, and if I receive maturity amount today, what is the consequence? Now you have taken policy after 2003, before 2012, right? Now what is the premium that you are paying every year? Is it exceeding 20% every year? No. It is less than 20%. Then it's a non-commercial policy. The maturity amount that you are receiving is fully exempt. It is fully exempt. Okay. So if the premium paid on the policy yearly do not exceed 20, then only I can claim exemption here. Suppose the premium paid by you crosses 20% of the sum assured, it is fully taxable. Suppose if the policy is issued on or after 1st April 2012, then annually how much you are paying? I am paying less than 20%, less than 10%. I am paying annually less than 10%. Then the maturity is exempt. If the policy is taken on or after 1st April 2013 for a disabled person, getting the point, and disabled person, and that policy premium every year what we are paying is not exceeding 15, it is less than or equal to 15%, then maturity amount is exempted. Very simple. Within these limits only, what is it? Within these limits only, if you are annually paying the premium, within these limits only the annual premium that you are paying. See, for ATC, you may be paying premium more than this also, but you will get deduction up to this. But for getting maturity amount exemption, the premium amount that you pay every year shall not cross. It shall not cross these percentages. If at all, even in 1 year premium crosses these percentages, maturity amount is fully taxable for you. But remember, whether premium paid is more than 20%, more than 10%, more than 15%, even though maturity amount received is exempt, only in one situation, on the death of the person, if you receive maturity, it is exempted. This is what 1010D talks about. Actually, in 1010D, it also talks about ULIP related exemption and all. We have a capital gains chapter inside that, 112A, 111A, 214. In all these three cases, capital is a definition. They have added one more point, ULIP, where the annual premium paid exceeding 2.5 lakh. That entire ULIP related taxation we don't have in CA Inter. It is there only at CA final. That's why in ICS tri-metal also, ULIP related discussion is completely eliminated. So this is regarding ATC, one of the important point, that is life insurance premium. So that entire theory, whatever I have explained you right now, is completely discussed here. That is completely discussed here. And remember, whenever you are receiving maturity amount on Keyman insurance policy, it is always taxable. 1010D, not 10 clause 10D does not exempt Keyman insurance policy. So accordingly, the maturity amount is taxable under other sources or salaries or PGBB, as the case may be for Keyman. Normally, if I am receiving maturity amount from life insurance policy, if at all it is not exempt under 10 clause 10D, it is taxable under income from other sources. That's it. So related to that, one illustration is also given in our book. If you want to solve the illustration, you can open and solve it. Next, another one. Contribution to statutory provident fund, public provident fund, recognized provident fund. So contribution to provident fund is eligible for deduction. Suppose if you are working in a company as an employee, you are contributing, your contribution to provident fund is, you can claim it as a deduction. So for that, illustration 3 is given, and maximum deduction for provident fund is 1,50,000. That to which provident fund? Public provident fund, relevant for MCQ. Then contribution to Sukanya Samriddhi scheme. Remember, in ATC, whatever points I am explaining you, only these are relevant. Remaining are not that important. So if at all, in respect of welfare of a girl child, if at all your contribution to Sukanya Samriddhi scheme, actually it is nothing but security of central government, subscription to any security or deposit scheme of central government. So one scheme, Sukanya Samriddhi scheme, is notified under that particular scheme. So if at all an individual is contributing to Sukanya Samriddhi scheme for girl child, the amount contributed is eligible for deduction. Contribution to any public sector company deposit scheme, getting it? Any notified deposit scheme, so they are exempted. Now this is another important point. Payment of tuition fee. Tuition fee means what? Nothing but coaching fee that you are paying. Getting the point? Even if you pay coaching fee, to an education institute like, Srestha, that is also eligible for deduction for your parents. Your parents can claim deduction for that. So payment of tuition fee to university, college, school, or other education institution within India for full-time education. Generally, CA coaching may not come under full-time education because it's a distance learning, right? Here, what you are paying is a private tuition fee. This may not come within the definition of tuition fee. Getting it? Normally, if at all you are pursuing some engineering or MBA or degree or 10th or 11th or 12th standard or school, that is eligible for deduction. So that to remember, the education must be within India. Only then it is eligible for deduction. And deduction is available only if the coaching fee is paid for two students. Only if it is paid for 2 students. Full-time education means it must be a regular course. It must be a regular course. Further, Another deduction is repayment of housing loan. Remember, here it is only principal repayment is covered, not interest. Because in the same point, what is inadmissible under this repayment of housing loan, what is not covered? The amount is, if any expenditure where deduction is allowed under 24, if at all you already claim a deduction under 24, what does it mean? Interest on loan you will claim deduction under 24 now for a house property, that is not eligible for ATC, which means indirectly what repayment? Only principal repayment is eligible for deduction. Now when you have taken housing loan, every month you will pay EMI. In the EMI, principal is there, interest is there. Interest amount you can claim deduction under house property itself. For principal amount you can claim deduction under ATC. And remember, the deduction is available only if the house property that you are buying, that is taxed under house property head of income. Suppose you purchased a building, land and building, you are using it for your business purpose, which means it is treated as block of asset in the PGBP head of income. Now no more deduction for that principal because you are claiming depreciation already. Suppose I purchased a house for residential purpose, so the house property is liable for tax under which head of income? House property. So I am claiming interest. Principal you can claim here. So along with principal, you can also claim stamp duty charges which you pay at the time of registration, registration fee that you pay at the time of registration, and any other expenses at the time of purchase. So all purchase related stamp duty, registration, transfer expenses, all that you can claim deduction. Able to understand? That's it. So with this, housing loan point is also completed. Next, suppose if the SSC is depositing in a post office term deposit, remember it is term deposit, not savings deposit. If at all you are depositing in a post office is covered here. This is bank. So either with a bank or with a post office, if at all you are depositing an amount for a value exceeding 5 lakh, for a period exceeding 5 years, minimum 5 years. So 5 years savings bank, 5 years a fixed term deposit with the bank, 5 years term deposit with the post office. Whatever you deposited, minimum deposit period must be 5 years. You should not touch it. Then you can claim the amount deposited as a deduction. Remember, ATC is completely investment based, savings based, retirement based section. So wherever you are investing, wherever you are saving, wherever you are planning for retirement, all these amounts you can claim deduction under ATC. I hope you are clear. The maximum limit for investment and term deposit is 1.5 lakh. You know what? ATC section itself has a limit, 1.5 lakh. The total deduction under ATC itself cannot exceed what? 1.5 lakh. Getting it? Fine. Next. Contribution to national pension system. Fine. I will come to this point at the time of ATCCD explanation. Getting it? ATCCD explanation, I'll come back. Now, there is something called retaxability. Like, what is this? Now, I told, right, house property related principal amount you are repaying. No, that you can claim deduction. If at all that house is sold within 5 years, you are claiming deduction from the past 3-4 years for principal repayment before completion of 5 years from the end of the year in which you purchased. When you got the possession, if from that year, 5 years also not complete. Within that you sold. Now, earlier you claimed deduction under ATC for principal repayment. Whatever deduction you claimed and allowed under ATC, retaxable. Same way, insurance policy is there. Minimum 2 years you should hold it. Before completion of 2 years, if the insurance policy is surrendered, whatever the amount you got, earlier you claimed deduction for payment of premium. That amount paid, deduction which is allowed to you, retaxable. 5-year term deposit with a bank, 5-year term deposit with a post office, senior citizen savings scheme, like this, some points were there. If at all you closed them within 5 years itself, at the time when you deposit, you claim a deduction, that is retaxable. So that's ATC for you. This ATC is over. Approximately 15 minutes we spent only on ATC, some 13 to 14 minutes. That's it. So ATC is over. I hope you are clear. Now the another section that we have is, so with this now ATC is over. In this ATC, I kept 1 point pending, contribution to NPS tier 2 account. I will come to that later. Now the next section, 80CCC. 80CCC is very simple. Contribution to LIC pension fund or any other insurer. Getting it? You see here. So where an SSC being an individual, getting it, paid or deposited for any annuity plan of LIC of India or any other insurer for receiving pension from the fund set up by LIC, nothing but you are contributing to LIC pension fund for receiving annuity at a future date. Suppose if you are contributing to pension fund of some mutual fund, pension fund of Unit Trust of India, that is covered in ATC. Pension fund of LIC you are contributed, or pension fund of some other insurance company you contributed, then that is coming under 80CCC. And in 80CCC there is one condition which can be tested in MCQ. The contribution must be out of the income that is chargeable to tax. Only from your taxable income you got, right, in gross total income, from that only that amount should be contributed. Suppose now you have agricultural income which is exempt, from that some amount you took and contributed to 80CCC, you will not get deduction. Only from taxable source of income you should contribute to 80CCC, only then you will get deduction. This item they will be testing. Now what is the impact of this item cannot be explained in revision class like this. I hope you are clear. Now under 80CCC, overall ceiling limit, maximum deduction under 80CCC is 1.5 lakh. Now you see here. Now you observe under 80C what is the limit? 1.5 lakh is the total limit. Under 80CCC also what is the limit? 1,50,000 is the limit. Be able to understand? Now don't worry. Let us keep it like this. The 80CCC over. Now 80CCD. 80CCD. What is this 80CCD? Understand the structure of the provision. Contribution to National Pension Scheme, Atal Pension Yojana, Central Government Pension Scheme, Central Government Pension Scheme. Again, if you use the word Central Government Health Scheme, that is 80D, not 80CCD. Pension Scheme of the Central Government. Okay, so to this, two people are contributing. Now, generally, SSC, let us talk about SSC contribution. SSC contribution. Suppose if this SSC is working in a company, the company will also contribute. That is called employer contribution. That is called as what? Employer contribution. Now, employer contribution is covered under 80CCD subsection 2. SSC contribution is covered under 80CCD subsection 1, 80CCD subsection 1B. Suppose SSC contributed some amount. Let us assume some amount is contributed. Let us assume 2 lakhs is contributed by the SSC out of his pocket. 2 lakhs he paid to National Pension System. Now up to 50,000 rupees. Up to 50,000 rupees at first. Claim it under 80CCD 1B. SSC paid out of his pocket now. How much he paid? First identify how much he paid. 2 lakhs, 1.5 lakh, 1 lakh. How much he paid? Check out. From that, take 50,000. Allocate. So you have to allocate under 80CCD 1B. How much? 50. So claim deduction. So deduction is 50,000 up to 50. Suppose SSC contributed 20,000 only. Then under 1B, how much we allocate? 20,000 only we allocate. Now, what is the balancing figure? The balancing figure is out of 2 lakhs. Already 50,000 allocated now. So what is balancing figure? 1,50,000. Now can I claim deduction for this entire 1,50,000? No. This is restricted to 10% of salary. In case if the SSC is a salaried employee working in an organization, then the National Pension System contribution coming under clause subsection 1 is restricted to 10% of salary. Getting it? For a salaried employee. Suppose if the SSC is not a salaried person, he is a self-employed person. Then the subsection 1 contribution is restricted to 20% of gross total income. Able to understand? Either 10% of salary or 20% of gross total income. As the case may be. It's not whichever is higher, whichever is lower. No, not that. As the case may be. For self-employed, we check 20% of GTA. For salaried employee, we check 10% of salary. Remember, when you contribute out of your own pocket, first 1B is saying up to 50,000, take deduction happily. Now, balance if at all you contributed extra, then keep it under clause 1, subsection 1. Under subsection 1, how much reduction you can claim? Up to 10% of salary if you are a salaried person. If at all you don't have salary income, then what is your gross total income? On that 20% we will allow. Now, there is a section. Now, now ATC, what is the deduction? 1,50,000. 80CCC, what is the deduction? 1,50,000. 80CCD subsection, what is the deduction? 10% of salary or 20% of gross total income, as the case may be. ACMB, let us assume. Now, there is a section under all these 80CCE, there is a section. What this section says, the total deduction that you can claim under ATC, under 80CCC, under 80CCD subsection 1 only. Some students may think entire 80 CCD is covered in overall limit. No, no, no. Only subsection 1 is covered within the overall limit. So the total deduction under these three sections cannot exceed 1,50,000 rupees. Please make a note. This is called overall limit. This is called overall limit. Under ATC you can claim total 150. Under 80 CCC you can claim total 150. Under 80 CCD subsection you can claim 10% of salary up to, or 10% of 20% of GDI, whatever applicable. You can claim under each section like that. But all these three sections put together, there is an overall limit, and that overall limit is 1,50,000. And remember, within this overall limit, subsection 1B, subsection 2, they are not covered. You clear? Next, okay, under 80 CCD, no, employer also paid, no, you are working in a company, he paid, no, whatever he paid, no, that amount also you can claim deduction. Now you might get it out. Sir, why will I get deduction if at all my boss paid? Very simple. You see 17 subsection 1, salary Setoff income, salary definition. Salary definition includes contribution to national pension scheme by the employer. Getting it? That is treated as salary income in hands of employee. So when he paid to the fund, no, national pension fund, no, that entire amount is taxed in your hands as salary. So whatever he paid, no, it is taxed for you. Now it is ultimately paid. You didn't receive, no, it is paid, no, contributed, no. So you are claiming deduction. So when he paid, it is treated as your income, which means your income only you paid. So it is taxed in your hand. Then again you can claim deduction under 80 CCD subsection 2. Now, like suppose employer contributed 2 lakhs in your name. Let's assume employer contributed how much? 2 lakhs in your name. Okay, this 2 lakhs is treated as income from salary. In gross total income it is considered. Now, what is deduction under 80 CCD subsection 2? The maximum deduction is 10% of salary. You will get deduction up to how much? 10% of salary. Suppose if you are a government employee, then 14% of salary is the maximum deduction. Let us assume, what is meant by salary? Here also 10% of salary, here also salary, here also salary is used. What is meant by salary? Basic plus DNS elements if terms of employment or forming part of retirement or for retirement benefit, any word they may give. DNS elements, terms of employment, forming part of employment, for retirement benefit, some word they will give. So that DNS elements only you should consider. So basic plus TA. So what is the total basic plus DNS elements, terms of employment for retirement? Total it throughout the year. On that apply 10% or 14% for government employee. That much only you can claim deduction, maximum. Employer contributed 2 lakhs. 2 lakhs is taxed for you. That doesn't mean entire 2 lakhs you will get deduction. Deduction is restricted to 10% of salary or 14% of salary as a case may be. And remember, the deduction under clause 1B, subsection 1B and the deduction under subsection 2, these two are in addition to overall limit. And now in ATC we kept one point, no, this NPS, no, there are two tiers, tier 1, tier 2. Tier 2 NPS, tier 2. Tier 1 is what? Entire ATCCD, whether it is subsection 1, subsection 1B, subsection 2. So whether you or employer, whoever is contributing, generally you are contributing to tier 1. The tier 1 comes under ATCCD. Suppose if you are contributing to additional account of NPS, in NPS only you have additional account. To that account you are contributing, that is actually called as tier 2. Second priority will be given to that for deduction. And if you contribute to national pension scheme tier 2, you will get deduction under 80C, and that is what here it is given. So contribution to tier 2 of national pension scheme, that is covered under 80C section. Generally if you are contributing to tier 1, in exam they will give you tier 1 contribution, 80CCD you should apply. If in exam they mention tier 2, then it comes under ATC. If it is tier 2, it comes under ATC. It is covered in overall limit. So which is beneficial? If at all you want to contribute to tier 1, which is beneficial for you. Able to understand. Next. So that's ATCCD. Whatever matter I have given you entirely explained here. Now here in ATCCD, one more important point is there. Suppose you are closing this pension account. Whenever you are contributing, whenever your company is contributing, your boss, you are claiming deduction under 1, 1B, 2. And like that you are claiming deduction. After certain number of years, you closed this account or you opted out of this scheme. Whatever amount you receive, it is fully taxable. Remember, it is fully taxable. Suppose if your nominee or legal heirs have received because of the death of the person, it is exempt. If the person closed the account and received the money, fully taxable. If this fellow died, nominee or legal heirs received, fully exempt. Now, okay, this fellow is only there. This fellow is closing the scheme completely, opting out of the scheme, closing the pension scheme, and entire money he withdrawn. So NPS, NPS trust, the scheme, whatever is there, they are paying to an SSE on closure. So whatever NPS trust is paying to SSE on closure of the scheme, that is taxable for the SSE. However, up to 60% of the total amount that you are receiving, whatever the trust NPS paying to the person, out of the total amount, 60% is exempt, 40% only taxable. Which means if a person closing the NPS account and receiving lump sum money, getting it on closure, permanently or closing, 40% only taxable, 60% exempt. Suppose, sir, I am not closing fully, sir. I am only withdrawing partially for some emergency purpose. What is the tax treatment? How much you partially withdrawn? Check out. 10 lakhs I withdrawn, sir. Now, till the date when you made a withdrawal, how much you contributed, sir? 5 lakhs only contributed. Out of the contribution, 25% is how much? So 5 lakhs into 25%, 1 lakh 25. Yeah, 1 lakh 25. So up to 1,25,000 you can claim exemption. Remaining 8,75,000 is taxable under income from other sources. So if you partially withdraw from NPS account and the NPS trust is paying you the withdrawal amount, so in that 25% of the amount contributed by you, that is exempted. That's it. So this 80cc is also completed. Now let's come to 80D. Now I hope you are able to understand. If at all you felt somewhere like little speed, see, for sure revision class can never be a substitute for a regular class. Okay, don't expect regular class kind of clarity in a revision class. Here, even though it is a revision, I am giving you entire information clearly. I am not skipping any part of the information. Getting it? Now 80D. Now 80D also you should understand structure very clearly. In 80D, you can claim deduction for premium paid on medical policy. You can claim deduction on preventive health checkup expenses. You can claim deduction on medical expenditure on senior citizen who do not have medical policy. Suppose if a senior citizen is there, or for him medical policy is not there, then you are incurring some medical expenditure treatment, that you can claim deduction. Or you are paying premium for medical policy, you can claim deduction. Or you are paying health checkup expenses, you can claim deduction. Now the section says for first item and the third item, you can claim deduction only if it is other than cash. So medical expenditure on senior citizen, you spend the money by other than cash, then only you will get deduction. Premium on medical policy, you will get deduction only if it is paid by other than cash. But preventive health checkup can be either in cash or other than cash, no restriction. And remember, the section says maximum deduction for preventive health checkup is 5,000 rupees. Maximum deduction for medical expenditure for a senior citizen for whom there is no medical policy, maximum deduction is 50,000 rupees. Now for the premium, what is the deduction limit? Now under 80D, the policy can be taken, the premium can be paid in respect of two categories of people: SSE, spouse, getting it, dependent children. They have clearly used the word dependent children. Getting it? Children can be minor or major, doesn't matter. Even in ATC they use the word any children, no dependency condition. LIC premium can be paid for spouse and children also, but they're dependent or non-dependent, doesn't matter. But in 80D, if your children is dependent on you, for him if you are paying medical premium, then only you will get deduction. And children can be minor or major, doesn't matter. And you are paying to parents. Parents can be dependent or non-dependent, doesn't matter. So this is category 1, this is category 2. Now you know what 80D says. The total deduction for medical premium paid for the SSE, spouse and dependent children, cannot exceed 25,000. So maximum deduction is 25,000. Suppose if at all you are taking medical policy for parents also, you are only bearing the premium, you are only paying the premium, then maximum deduction for parents separately can be claimed up to 25,000. Suppose many students think, sir, for parents 50,000. No. 50,000 limit is for senior citizen, not parents. Suppose if your parents are not senior citizen, they are less than 60 age, then 25,000 only maximum deduction for that particular category. Suppose if at all your parents are senior citizen, then maximum deduction is 50,000. Suppose if the SSC or spouse or children, if in this category if any one person is senior citizen, then the maximum deduction is 50,000. Able to understand? First of all, under 80D, medical premium paid, you can claim deduction Deduction will be given for two categories of policies. Policy taken for self, spouse, dependent children. Policy taken for parents, whether they are dependent or not. For self, spouse and children, dependent children, maximum premium is 25,000 allowed as deduction. For parents, another 25,000 separately you will get deduction. Suppose in category 1, he's a senior citizen, the limit is 50,000. If parents are senior citizen, then limit is 50,000. And you know what? The section limit itself, the maximum deduction that you can claim. Remember, the maximum deduction that you can claim under 80C, like 80CCC, there is a maximum limit. What is the total section limit? 1.5. Same way, 80D also, there is a maximum limit. So what is a maximum limit under 80D? Maximum limit under 80D. How much is the maximum deduction? Suppose if category 1 is normal citizen, category 2 also normal citizen, parents also, then maximum deduction is 50,000 rupees. Suppose if category 1 SSC is normal, but category 2 parents or senior citizen, then he can claim 75. Nothing but for category 1 25, category 2 50. Suppose category 1 senior plus category 2 also senior, then 50 plus 50 is equal to 1 lakh is the maximum deduction. This is the maximum answer that you can claim, that you can get under 80D. Now remember, sir, you said just before preventive health checkup 5,000 deduction, for medical expenditure 50,000 deduction, provided it is for a senior citizen where there is no medical policy. Yes, you will get these two deductions, but these two deductions are within the 80D limit itself. So within the overall 80D limit, only you can claim these deductions also. Able to understand. So for this also a problem is given in the illustration. So here in this book we have given enough illustrations. If you open and solve, you can understand very easily these two illustrations. You can download this PDF from our websites, restofcsema.com. You can go there, old scheme, new scheme you will find. So open old scheme or new scheme, anything, open P4, open P3, whatever it is, income tax, you can download this book. There you can find all this. This 80D is completed. Suppose, sir, I have paid medical premium. Getting it in lump sum. The policy is valid for 5 years. I have paid in lump sum amount medical premium. Getting it? Now, how can I claim deduction? You can claim proportionately for every year. Suppose you paid 1 lakh premium for 5 years policy. So every year you can claim 20,000 for each category. That's it. That's 80D for you. I hope you are clear. I have conveyed all the points. Next, 80DD. So deduction in respect of dependent with the disability. Suppose if the SSE, now dependent, suppose if at all disability, so deduction for disability. Who is suffering this disability? Suppose if the SSE himself is suffering, he can claim deduction under 80U. Suppose some dependent on the SSE is suffering from disability, then SSE can claim deduction under 80DD. Now remember, the deduction is for whom? Deduction is for SSE. If SSE is suffering, he can claim for himself under 80U. If his family member is suffering, 80DD. Now his family member is suffering. What do you mean by family of the SSE? Now here dependent means who and all. Getting it? So parents, brother or sister, spouse, children. And remember, all must be dependent on the SSE. All must be dependent on the SSE. And remember, this is only available for resident individual. This deduction is available only for resident individual in case of HUF, resident HUF. Now okay, what is the amount of deduction? How much you really spent doesn't matter. If you are suffering from disability, have you taken any treatment? Have you taken any insurance? That and all, no questions. In exam, they will give you information that SSE spent this much, SSE have this much expenditure, that and all irrelevant. Suppose if you are suffering from normal disability, flat 75,000 deduction. If you are suffering from severe disability, flat 1,25,000 deduction. Now, whether you are suffering from normal disability or severe disability, a medical practitioner has to give you a certificate. Getting it? So further, there is a format. Getting it? Like there is an act called Equal Opportunities, disabled people, equal opportunities, full participation, some act is there. In that act, they have mentioned what are all the disabilities that are covered. Autism, cerebral palsy. So that is also covered recently. Some three disabilities are also covered. That list is unnecessary for us. Understand the theme of the point. If SSE himself is suffering from disability while filing his IT return under section 80U, he can claim deduction of flat 75,000. If at all it is a normal disability. If at all it is a severe disability, he can claim a deduction of 1,25,000. I hope you are clear. Suppose I am not suffering, but my family member is suffering. What can I do? I am only maintaining them. They are dependent on me. So I am incurring some expenses. Somehow I am incurring something. irrespective of how much ever you incur. If family member is suffering from disability, normal disability, 75,000. If at all family member is suffering from severe disability, 1,25,000. In exam, if at all type of disability is not given, for a problematic paper, assume that it's a normal disability. If it is a true or false question, write both the answers. If at all it is a normal disability, 75,000. If at all it is a severe disability, 1,25,000. But for a practical question, if disability is not clearly mentioned, then assume that it is normal, claim 75,000 deduction. Suppose, sir, now dependent is suffering from disability, sir. Suppose, no, there are 3 dependents on me who are all the 3 of them are suffering from disability. So can I claim multiplied by 3? No. This is section limit itself. The maximum deduction under the section itself is this much. Either 75 or 125. Any one only you can claim. I hope you are clear. 80 DD over, 80 U is also over. Now, suppose, no. Now let us look at 80 DDB. 80 DDB. So that is what 80 D completely I told. Sometimes, no, here there is a point on deemed income. What is this point? I'll tell you. What is this point? In fact, this point is there in 80C also. Suppose, no, there is a dependent on me for whom I have taken an insurance policy with an insurance company. If something happened to me suddenly, he is dependent on me, know how he will survive later on. So I have taken an insurance. If something happened to me, he will get a maturity amount. So if something happened to the SSE, the SSE's dependent got the maturity amount fully exempt. Suppose if dependent deceased, if a dependent died on for whose safety and security purpose I have taken the policy, that dependent, he died. Now I am receiving the maturity amount ultimately at the end of the policy, fully taxable. No exemption under 10 clause 10D. It is fully taxable. So if the dependent predeceases the individual who has taken the policy for the security and safety of the dependent, receives the amount from the insurance company on maturity, it is taxable in the hands of the individual. I think it fine. Now 80 TDB. Here the SSE or family members, all of them or any of them suffering from disability, suffering from a specified disease, either the SSE or family member. So family member means nothing but dependent family member. Dependent means what? Same parents, brother or sister, spouse, children. All these are dependent on the SSE. Either the SSE is having disease or any of them is having disease or all of them are having disease. Doesn't matter. Suppose under 80 DDB they have given some list of diseases. If at all the SSE or family member is suffering from those diseases, up to 40,000 rupees or actual expenditure incurred, whichever is lower, you will get deduction. Here deduction is linked with actual. You see disability section 80 DD 80 U, how much you actually spend doesn't matter, you will get flat deduction. Whereas in 80 DDB actual expenditure is how much, so that is very very important. So 40,000 rupees up to 40 or actual whichever is lower, that much is a deduction. Suppose no, if the person who is suffering from disease is a senior citizen, then the limit is extended to 1 lakh. So up to 1 lakh you can claim deduction, which means under 80 DDB what is the maximum limit? If the person who is suffering from disease is a normal citizen, up to 40,000 deduction. If the person suffering from disease is a senior citizen, up to 1 lakh they can claim deduction. And remember, this section is also applicable only for resident SSE, resident individual. 80 DD, 80 U, 80 DDB, all these 3 sections are applicable only for resident individual, resident HUF. I hope you are clear. 80 DDB is also over. So that's what 80 DDB, that is completely whatever the points covered here, we have clearly explained you all these points. Getting it? Next, 80E. Now what is this 80E? Now let's once again come back to our list. You see how easy chapter 6A. See, in chapter 6A, why many students confuse. Some students know they literally don't understand chapter 6A correctly. The main reason is they don't understand the structure of the entire section. Each and every section, the structure they don't understand. And I gave an introduction, no, in the initial 5 minutes, the total chapter 6A cannot exceed gross total income. That is very important, because when you're solving total income problems, there many students do mistakes. Because they claim deduction from gross total income directly without understanding a gross total income, LTCG is there, STCG 111 is there, because they are not eligible for chapter 6. Remember. So now 80CCD clause 1, 80CCD clause 1B, 80CCD clause 2, 80CCE, 80DD, all these sections are over now. Yes or no? By the way, let me highlight with it. Let me highlight in green color. So green means it is over. We have discussed it. You see how fast we are discussing. Already some 45 minutes. We discussed almost more than half. Now let's look at 80E. Now you know this is bit complicated. This is 80G, 80JJAA. These two are bit complicated, and next complicated one is 80QQB. You know, in the pending items, these three are bit complicated. So anyhow, I will make it very simple for you. It's very easy. Understanding structure is very important. Fine. Now, these 4 sections are interest related sections. I am not even opening the content directly. I'll explain you. Getting it? What is 80E? 80E talks about interest on education loan for higher education, which is taken from bank or financial institution or something. Only that interest paid is eligible for deduction. Now remember, for how many years you will get deduction under 80E? For 8 years you will get deduction. From which year? First year you start paying interest on education loan. No, first time. From that year, 8 years. Many think that under 80E, interest on education loan, you will get deduction from the year of taking the loan. No. See, banker gave me education loan. I am the one who wants to go abroad and study some education. They gave me loan. I took loan because I don't have money to pursue education, and after that get a job. Then after that I will earn. Then I will repay the bank. So the year in which I have taken education loan, the year in which I started earning will be some 3 or 4 years gap will be there. So bank also will wait until this period. Only after I started earning, banker will collect the interest from me. So from the first year in which banker is collecting interest, total 8 years interest amount, whatever I am paying, I can claim deduction. And remember, education loan interest, I can pay for individual, spouse, children. Able to understand. You see here, 80E. So interest on education loan, getting it? So spouse and children, and remember, there is no dependency condition. Dependency point is not there. And even if I have taken education loan for purpose of for the purpose of somebody for whom I am the legal guardian, that is also eligible. Remember, only for higher education. Now remember here one more point. Education can be within India or outside India. Now here, what deduction you get? Do you get deduction for tuition fee? No. You get deduction for interest on loan taken for higher education. Interest amount only you can claim deduction. Sir, I have paid fees to the college. Wow, how can I do? That tuition fee, if it is paid within India to some college or education institute, that you can claim deduction under 80C. That's it. That's 80E. Next. That's 80E. I hope you are clear with 80E. Now, let's look at 80EE, 80EEA. So what these sections are? These sections 80EE, 80EE and 80EEA. So these sections are brought with a view to give deduction for first time home buyers. So 80EE, 80EEA. So first time home buyers. So if at all a person is buying for the first time house, getting the point, first time home buyers means, see, in these two sections, so what is the point? These two sections says you have taken a housing loan. You are paying interest on that. That house is subject to house property head of income. You are claiming deduction already for interest amount on house property. But you know very well, for a self-occupied property, unoccupied property where NAV is equal to 0, maximum interest on loan you can claim is how much? 2 lakhs. Suppose you are paying to a bank 3 lakhs. Now extra 1 lakh you are not claiming under house property. That you can claim under these two sections. Any one only. Either one. If at all you already covered under 80E, no more 80EA. Any one only, mutually exclusive. Suppose you have not taken 80EE benefit, then you can take 80EEA benefit. Getting the point? Like, so you are paying interest on loan, housing loan. That interest is eligible for deduction here, provided on that interest you did not claim any deduction under house property. Getting the point? Suppose suppose there is a let out property. I have paid 3 lakhs interest under house property. Now I can claim for let out total deduction, but don't claim 2 lakhs only. Why? Even if you claim total deduction for a let out property interest deduction, even the net result is loss, you cannot set off with other head of income beyond 2 lakhs. So if at all the total interest after reducing, if at all loss is beyond 2 lakhs, the extra amount of interest is there, where loss is crossing 2 lakhs, because you can't set up with other head. That interest you can claim under 80EEA or 80EE as the case may be. Under 80E, maximum deduction for interest is 50,000 rupees. For how many years? From the year in which you took the loan till the year 20 years or 30 years or 15 years till you repay the loan. 50,000 interest portion you can claim. Under 80EEA, it is 1,50,000. Under 80EEA, it is 1,50,000. Now, what are the conditions? Date of sanction of the loan should be between 16 and 17 previous year. So 1/4/2016 to 31st March 2017. Within this previous year, within this financial year only, you should get sanction of the loan. And the loan sanction amount shall be less than or equal to 35 lakh under this section. And value of the house should not exceed 50 lakh. So if these conditions are satisfied, then interest on loan paid up to 50,000 rupees, you can claim deduction under 80EE. Now in ATE, only in this year, if at all you have got a loan for housing purpose, then only you will get deduction. What about subsequently? No more deduction under ATE. That's why, in 2019, they have introduced another section for first time home buyers. Suppose you have taken a loan, between 1/4/2019, you have taken a loan between 1/4/2019 to 31st March 2022. Between these 2 years, if at all you have taken a loan, getting the point, and the stamp duty value of the house is not exceeding 45 lakh. You remember under ATEEA, stamp duty value is what referred, whereas here value of the house is what referred. Getting it? So stamp duty value is not exceeding 45 lakhs and the loan is sanctioned between this date. Then interest on that loan, you can claim deduction up to how much? 1,50,000. Remember, if at all the total interest is 1.5 lakh, you already claimed under 25, that 1.5 lakh under house property, you cannot claim further here. Further, ATEEA, this section is not open for whom? Those who already claimed ATEE. In both the sections, the date on which loan got sanctioned, on this date, you should not have any house property at all. Which means, by taking this loan only, you are buying the house for the first time. First time home buyers only this provision. Understood or not? Next we have ATEEB. Next we have what? ATEEB. What is this ATEEB? If at all you have taken any loan during 1/4/2019 to 31st March 2023 for purchase of electric vehicle, EV revolution started in 2018-19 onwards. Getting the point? When the Modi government have started the second tenure, they have brought a very big EV policy, e-vehicle policy framework has been brought. So that's why, to incentivize those who are using electric vehicles, this section has been brought. So what this section says, if at all you have taken if you have purchased any electric vehicle, for that purpose you have taken any loan during 2019 to 2023. Remember here 1/4/2019 to 31st March 2022. Here 1/4/2016 to 31st March 2017. Here 1/4/2019 to 31st March 2023. Means here, if you have taken loan in any 3 years, here you have taken loan in any 2 years, here you have taken loan in 1 year. So every time they have increased the time limit. Observe this. So to purchase an electric vehicle, you have taken a loan, and the loan is sanctioned between 1st April 2019 to 31st March 2023. Whatever interest that you are paying on that loan, that interest component only, you can claim deduction under ATEEB. If at all the entire interest paid is already claimed as a deduction under some other head of income, you can't claim here. Suppose I purchased an electric vehicle for my business. That asset I have added in my block of asset. Interest paid on that vehicle I am claiming under 36 section, deduction in PGBP. I cannot claim ATEEB. So with this over. Now let's look at ATG, ATGGA, GGB, GGC, GG. Now ATG, one of the confusing section. Many students have some confusion on ATG. Why? Because the computation of ATG, many students will confuse. Okay, fine. So ATG, in ATG, they have given approximately 30 plus deductions. 30 plus. ATG is what? You are getting deduction for donations. You are paying some donations. For that reason, you are getting deduction. Now, the donations that you are paying, these donations under ATG are classified into 4 categories. They are classified into 4 categories. Category 1, Category 2, Category 3, Category 4. Look at the structure of this ATG. If you understood the structure, it's very simple. Okay, so 4 categories were there. Okay, now how to solve the problem? Directly they'll give you list of donations. On ATG itself, they may give you an exclusive problem for 4 to 6 marks. So in that case, how to? So first identify which donation comes under which category. Suppose under category 1, some 3 donations paid by you. All the 3 donations put together 1 lakh is the total. Okay. Under category 2, you paid some 4 donations. 4 donations you paid. All the donations comes under 75,000. Under category 3, category 3 related payments, you gave some donation. That amount comes to 1 lakh. Under category 4, you paid some 2 or 3 donations. The total amount paid comes to some 75,000 rupees. That's it. Okay. Now, what is the deduction? This is the amount paid by me. Belonging to category 1, belonging to category 2, belonging to category 3, belonging to category 4. All these amounts were paid by other than cash. Why? In ATG, if you are paying any donation exceeding 2,000 rupees to any fund or institution, you have to pay by other than cash. Otherwise, no deduction. Now, how much is the deduction? 100% into 50%. Here 100% into 50%. Very simple. Simple. What is the amount paid? Apply 100% for category 1. So what is the deduction? 1 lakh. What is the deduction? 75,000 into 50%, man. So 37,500. What is the deduction here? Don't apply. For category 3, category 4, there is one more condition. Category 3, category 4 put together, how much you paid? 1,70,000 you paid. The payment made under category 3, category 4 shall not exceed. There is a condition. The payment made under category 3 and category 4 shall not exceed the qualifying limit. What is qualifying limit? 10% of adjusted total income. You paid 175, but entire 175 payment we don't consider. Only some of it will consider. How much you will consider? We will not be the total payment belonging to category 3, category 4. Payment I'm talking, not deduction. Payment itself. It shall not exceed 10% of adjusted total income. So that is the how much ever you paid entirely will not qualify for deduction. See, you see here, if category 1 lakh is qualified for deduction, 75,000 is qualified for deduction. Of course, 75 is qualified for deduction, but deduction is 50%. Here, 1 lakh is qualified. Deduction is also 100%. So 1 lakh. Now, whereas here you paid 1 lakh and 75. 175 you paid. Entire 175 will not qualify. How much will be qualified? The both category 3 plus category 4 put together total amount paid cannot exceed qualifying limit. That is 10% of ATI. Now what is adjusted total income? Adjusted total income means gross total income minus LTCG minus STCG 111A minus exempted incomes if any were there. But remember, minus 115 BP winnings should I reduce? No need. No need to reduce. I have explained the reason very clearly in my regular class. Why winnings amount need not be reduced, I will clearly explain. Fine, anyhow. Now you get minus chapter 6A deductions. All chapter 6A, right from 80C to 80U. Getting it? So 80C, 80D series, 80G series, 80GG, 80TT, 80QQ, all the deductions you reduce except 80G. Whatever comes under category 1, 2, 3, 4 of 80G, is there no total deduction? That you don't reduce. Remaining all chapter 6A, reduce it from gross total income. LTCG reduce. STCG 111A reduce. Now you will get some adjusted total income. That is, let us assume 10 lakhs we are getting. Actually, gross total income is 40 lakhs. Capital gain is some 10 lakhs. Short-term capital gain 111A is some 15 lakhs. All chapter 6A deductions put together 5 lakhs. So 40 minus 10 minus 25 minus 5. Getting it? Sorry, minus 15. 40 minus 10 minus 15 minus 5 is equal to adjusted total income 10 lakhs I'm getting. Now into 10% how much? 1 lakh. Which means under category 3 plus category 4 put together, what is the maximum donation you can pay? Lakh only. But this fellow, in this case, how much this fellow has paid? This fellow paid 1,75,000. Let us assume the total income is 12 lakhs. Qualifying 10% is 1,20,000. Let us assume for better understanding. What this fellow has paid? This fellow paid 1,75,000. But how much he can pay? 10% value comes to 1,20,000 only. But here they paid 175. 175 is restricted to 120. So first I have 120 only limit. Here I paid 1 lakh. So qualifying limit entire 1 lakh. I will allocate 1 lakh here. Now after allocating 1 lakh, how much is left? 20,000 is left. That 20,000 allocate here. Okay. So this 75,000 is restricted to 20. Now both put together under category 3, category 4, we restricted to qualifying limit. Now how much? 120. Now apply 100%, apply 50%. So 1 lakh deduction for this amount, 20,000 into 50%, 10,000 only deduction. So that's it. What is the total deduction under ATG? So 1 lakh plus 37,500 plus 1 lakh plus 10,000, 2 lakh 47,500 is the deduction. Category 1, amount paid multiplied by 100%. Category 2, amount paid by multiplied by 50%. Category 3 and 4, amount paid identified. Both put together, reduce it up to 10% of ATA. Suppose if 10% of ATA is in this case more than 175, no problem. On 1 lakh 100%, 75, 50%. But here 10% of ATA, qualifying limit comes only 120. So 120 only we will allocate for category 3, category 4. Already category 3, 1 lakh is there. So out of 120, 1 lakh I will allocate. First you will allocate qualifying limit is there, no? That limit first allocate it for category 3. Still limit is there. Allocate it for category 4. Now category 3, category 4 amounts paid, reduce it to qualifying limits. Apply 100%, apply 50%. This is the answer. Very easy. Now, sir, what is category 1? What is category 2? What is category 3? What is category 4? That is what we have given in ATG. So, category 4. So what are all comes under category 4? You are donating to charitable trust, all registered charitable trust, category 4. You are donating to government for charitable purpose. You are donating to government for charitable purpose other than family planning. Other than family planning. Suppose if at all you are donating to family planning for government, then that comes under category 3. Category 3 donation means what? Within the qualifying limit, whatever amount you paid, 100% you will get deduction. Category 4 means what? Within the qualifying limit, whatever you paid, 50% only you will get deduction. Suppose you are donating to Housing Development Authority for town planning, city planning, housing development projects, or you are donating to some corporation which is established exclusively for promotion of minorities' interest, you will get deduction under category 4. You are donating for renovation of religious premises, renovation purpose, getting the point. So for that purpose you are donating, category 4. Suppose you are donating for family planning, then category 3. Suppose if a company is donating for Olympic Association or any other sports associations, then it is coming under category 3. Remember, so if at all we are donating to Olympic Association or any association or institution which is established for development of infrastructure for sports, so Olympic Association or any association which is exclusively engaged in development of infrastructure for sports, for them category 3. Now remember, this Olympic Association only a company can click. In exam, they'll give you an individual contributed donation to Indian Olympic Association or some other association for development of infrastructure for sports. Individual donated, no deduction for individual, because category 3 Olympic Association, that point only for companies you will get. Then suppose if at all you contributed to Jawaharlal Memorial Fund, Indira Gandhi Memorial Fund, Rajiv Gandhi Foundation, getting it. So if at all you donated to Jawaharlal Nehru, Jawaharlal Nehru, Indira Gandhi and Rajiv Gandhi, getting it. So you will get deduction under category 2. Suppose you donated to Prime Minister Drought Relief Fund. Drought Relief Fund is not frequently used. Very rarely it will be used by Prime Minister. So it's not that important fund. That's why it is category 2. So how much ever you pay, only 50% deduction. Be able to understand. Remaining all other, like what are they? Prime Minister National Relief Fund, Prime Minister National Relief Fund, all state governments CM Fund, all state governments Governors Relief Fund. Getting the point? You will get deduction under National Sports Fund. Remember, if at all you are donating to any association for development of infrastructure for sports, that category 3. You are donating to National Sports Fund, that is category 1. Getting the point? In this, or you are donating for Swachh Bharat Kosh, you are donating for Clean Ganga Fund, or you are donating to Prime Minister Cares Fund. You might have seen this Cares Fund very frequently in COVID time. So you are donating to, very simple, if at all you are donating to somebody who do not come under category 2, category 3, category 4, it's a category 1 donation. How much ever you pay, flat 100% deduction. So this is what entirely we have given. All these points we have covered. And remember, if at all you are donating in kind, suppose you donated jewelry to a charitable institute, no deduction at all. That's with that 80G is over. Now let us look at 80GG. Okay, I'll come to 80GG later. Why? Because 80GG is not a donation section. 80GG is a deduction for rent purpose. So 80G is over. Almost 1 hour, more than 1 hour. Fine. Remaining all sections put together all hardly takes half an hour. No problem at all. Yes. So 80G is over. Now let's continue 80GGA. What is 80GGA? If you are donating to Scientific Research Association for carrying scientific research, or you are donating to Research Association for social research, or you are donating to Rural Development Authority or any other eligible project, or you are donating to Poverty National Urban Eradication Fund. Getting the point? So if at all you are donating to these institutions, whatever amount you donated, the entire amount you will get deduction, provided the amount exceeding 2,000 you cannot pay by cash, only by other than cash. Getting it? Now this section is not applicable if at all the SSC is having PGBP head of income. Suppose if the SSC is having PGBP head of income, the amounts referred under this section, no, whatever the donations referred under 80GGA, no, they're all covered under 35 subsection 1, clause 2, clause 2A, clause 3, 35 subsection 2AA, 35 CCD. So like that, these all points were covered in PGBP. So SSC who is having PGBP head of income, 80GGA do not apply. For remaining SSCs who do not have PGBP income, if these fellows are contributing for scientific research, if these fellows are contributing for social research, if these fellows are contributing for rural development, if these fellows are contributing for poverty eradication funds and all, Getting the point? That entire amount is eligible for 80 GGA deduction. 80 GGA is over. Next, 80 GGB, 80 GGC. Both these sections are talking about political party donation or electoral trust donation. If you are donating to a political party or electoral trust, single rupee also you should donate only in other than cash. Up to 2000 limit is not there. Up to 2000 80G, 80GG only limit is there in cash. But 80 GGB, 80 GGC, donation to political party, compulsorily you must pay by other than cash only. Only then you will get deduction. Now, if an Indian company donated, 80 GGB deduction. If anybody else donated, 80 GGC deduction. If an Indian company is donating, 80 GGB. If a resident other than Indian company is donating, 80 GGC. That's the 80 GGB, 80 GGC. These two are very simple sections. And 80 GGB, they have given a definition for what do you mean by contribution to political party. Contribution to political party includes advertisement expenditure incurred in the political party newspaper, brochure, magazine, or pamphlet, whatever. Getting it? That's why whenever we incur any advertisement expenditure related to political party newspaper or brochure, it is not allowed as deduction under PGBP. 37 subsection 2B, it disallows. Yes or no? Why? Because it is treated as a donation. Accordingly, that advertisement expenditure treated as donation, you can claim deduction under 80 GGB. Then 80 GG. Donation, deduction for rental expenditure. Suppose you are staying in a rented accommodation, you are paying rent. You can claim deduction. How much deduction? You can claim maximum the following deduction. Maximum. How much amount you are paying? How much amount you are paying? Getting? I mean, actual rent per month. This is a maximum deduction, or statutory limit maximum 5,000 per month only deduction, or actual rent. This point is not a good. Actual rent minus 10% of adjusted total income, or 25% of adjusted total income. This much only you can claim. Suppose the SSC is paying 15,000 rupees per month rent. Total how much is paying rent? 1,80,000. Let us assume adjusted total income is 1,15 lakhs or 10 lakhs. So actual rent is how much? 1,80,000. 10% of 10 lakh means 1 lakh. So how much it is? 80,000. Second criteria. 25% of 80 means 2,50,000. Full 12 months he has been staying in rented accommodation. So 60,000, 5,000 into 12. So 60 or 80 or 250, whichever is lower, 60,000 is a maximum deduction. So under 80 GG, the maximum deduction is 60. Now there are conditions. Now what is first of all adjusted total income? Adjusted total income means gross total income minus LTCG minus 111A, short-term capital gain, minus all chapter 6A deductions from 80C to 80U except 80GG. Now in 80G also adjusted total income is there except 80G all deductions. 80GG except 80GG all deductions. Now if SSC is having 80G, 80GG both the sections is having. Now how to calculate adjusted total income in both the sections? Linear equations we should apply. So that and all in-depth knowledge is not required. From exam point of view, that much they don't test at all. Getting it? Fine. Now what is the condition? Now first of all, who can claim 80GG? This is the one important condition. Suppose if the SSC is claiming self-occupied, unoccupied, NAV is equal to 0 benefit under house property, that fellow cannot claim. If the SSC is having deemed let out property taxation under house property, he cannot claim. If the SSC is receiving house rent allowance and claiming 10 clause 13A deduction under salaries chapter, he cannot claim. Only an SSC who is staying in rented accommodation, not having SOP, not having DLOP, not having HRA, he can claim deduction. Further, one more condition. Suppose, okay, you are not claiming SOP, DLOP, you are not having HRA, but you are staying in rented premises in the same city where you have a own house. You also cannot claim. Which means, in the same city where you have own house, you should not be staying for rent. You should be staying in some other city. Because of job, because of business, because of profession, whatever, you are staying in some other city. In that city, you don't have own premises. That's why you have taken on rent. The rent paid is eligible for deduction under 80GG. That's it. Over. 80GG section is over. I hope you are clear. Please, since this is a YouTube video, you can listen once again. If at all any of you feel that I'm little speed, understand it's a revision class. Getting it? I'm not simply reading, opening the book. I'm not simply reading. I'm giving you proper explanations. That's it. So with this 80GG is also over. Now let's finish 80TTA, 80TTB, and then I'll come back to these yellow items. 80TTA, 80TTB. First of all, 80TTA, 80TTA, this section you can apply for normal citizen. 80TTB, this section is eligible for senior citizen. First of all, 80TTB is only applicable for residents. Whereas 80 TTA, whether you are a non-resident or resident, doesn't matter. These are the basic important items. Non-resident means he may be more than 60, more than 80, doesn't matter, because senior citizen, super senior citizen, the words can be used only for resident people. Yeah. Now, what is 80 TTA? Suppose you are having savings account. On this savings account, you may be having with a bank or you may be having with the post office. You are getting interest. Let's assume you are getting interest of 20,000 rupees savings interest. Now, this is taxable under income from other sources. So, accordingly, gross total income it is covered. Now, under 80 TTA, you can claim deduction up to 10,000 rupees. That's it. 80 TTA is over. Suppose no. Here one important observation. Suppose no. If you are getting savings interest from post office. Suppose if this 20,000 is from bank, this is the tax treatment. Suppose if you get interest from post office, out of 20, 3,500 is exempt under 10 clause 15. Na? So 16,500 is only taxable under other income from other sources. This itself is gross total income. So minus 80 TTA, how much deduction? 10,000. So this is in case of post office. So for post office savings interest, 3,500 is exempt side away. So taxable income from other sources itself is 16,500 in this case. So minus 80 TTA, 10,000 over. This is for normal citizens, whether resident or non-resident, where they are getting interest on savings deposit, they will get deduction. I hope you are able to understand. Yes. Next, suppose no, you are a senior citizen. Senior citizens, generally their source of income is pension interest. So the senior citizen is having some fixed deposit with the bank or post office, also have some savings deposit with the bank or post office. Now he is getting from both of them put together 1 lakh income, taxable under other sources. Now since he is a senior citizen, we have given increased deduction, 50,000 rupees. Up to how much you can claim? 50. So now here 80 TTP, whether it is a fixed deposit or savings deposit, both are eligible. Interest on both these deposits are eligible for deduction under chapter 6 80 TTB. That too, this deduction is only for senior citizen aged 60 years or more and a resident in India. That's it. Over 80 TTB. Now we are left with 3 more sections. Okay. Now I will finish 80 QQB, 80 RRB. 80 QQB, 80 RRB. So once I finish those two, then 80 JJAA, very simple. I'll explain easily. I hope you are able to understand the concept. Please read in the book also. So I'm attaching you the book also PDF. The PDF is free. Illustrations were there appropriately at appropriate places. You can easily understand. Now 80 QQB, both these sections are for royalty income. So for royalty income. So what are the sections? 80 QQB, 80 RRB. If you are receiving royalty for books, you are authoring some book, scientific literature, arts, or you are having some patents for letting to use this patent for somebody, or you are transferring the rights in this patent to somebody, you are getting some royalty. Whatever the royalty income that you receive, it is taxable under PGBP income generally. Getting it? So it is included in gross total income. So now whatever the royalty income means what? Gross royalty minus any incidental expenditure is equal to royalty income. Now this royalty income in respect of the net royalty income which you receive, which is taxed in PGBP, getting it? For that net royalty income, you can claim deduction under 80 QQB. How much deduction? Suppose I received royalty in lump sum. So royalty income. Royalty income or 3 lakhs, whichever is lower, that much deduction I will get. Suppose if I am receiving royalty not in lump sum, I am receiving royalty as a percentage of books value sold, then up to 15% of the books sale value only royalty received, gross royalty received is calculated for exemption. Able to understand. On this, there is a clear-cut problem which is given. Now, whatever it is, whether it is lump sum, whether it is percentage of book value, the maximum deduction under 80 QQB cannot exceed 3 lakhs. The section limit itself is 3 lakhs. Even 80 RRB also, the section limit is 3 lakhs. Now, for books purpose, if you receive lump sum royalty, getting the point, how much is taxed in the PGBP? Balance amount, that income or 3 lakhs, whichever is lower. Suppose you received royalty as a percentage of sales of books, getting the point, then up to 15% of the gross royalty, that is only considered for calculating deduction. Out of that, already some PGBP deduction you claimed for expenses, reduce it. Balance amount only you can claim deduction under 80 QQB. The total deduction under 80 QQB, whether lump sum or otherwise, doesn't matter. Maximum 3 lakhs only. That's the provision. And now Now remember, sometimes you are receiving this royalty not within India, from outside India. In that case, one more condition is added. Exemption is once again restricted to how much amount of foreign currency is received in India, how much amount of consideration received in convertible foreign exchange within India within 6 months from the end of the previous year in which you received the income. Suppose for 22-23 you received some royalty, you earned some royalty, we taxed in PGBP on accrual basis, but by 30 September of the end of the financial year, 30th September is there, within that you received only some amount, 1 lakh only you received in convertible foreign exchange, then deduction cannot exceed 1 lakh. Maximum deduction is 3 lakhs. Again, this maximum deduction is restricted to how much you are receiving in convertible foreign exchange, if at all the royalty is received from outside India. The provision is same in both the sections. In patents, percentage of sales concept is not there. In patents, it's only lump sum. So this is QQB, this is RRB. Over. With this, QQB, RRB is also over. Now, next, finally, 80JJAA. Appa, one more confusing section for all the students. What is this 80JJAA? You see the section heading, deduction for additional employee cost. What is it? Deduction for additional employee cost. Now this section is applicable only for those who are having tax audit. Only for those who are having tax audit. Suppose if the SSC is subject to tax audit only, this section is applicable. For others, this section is not applicable. And remember, the deduction is for what? Additional employee cost incurred by the SSC only, the deduction you will get. Now, suppose the SSC is an existing business. Last year, as on the closing date, I am having 100 employees. This year, I am having totally 150, which means, is there an increase in employees by 50 members or not? Yes. Then only additional employees the definition you satisfy. That overall number of employees compared to last date in the preceding previous year, compared to current year, it should be increased. Then only this section is applicable. Then only you can claim deduction under this section. Now, how much I can claim deduction? You can claim deduction of 30% of additional employee cost for 3 years. You can claim 30% of additional employee cost for 3 years. You can claim deduction 30% of additional employee cost. So every year, whatever salary you are paying to these additional employees, on the 30%, every year you can claim. So in the every year, whatever the salary you are paying, so year 1, 30% of the salary. Remember, whatever salary you are paying, that entirely you claim deduction under PGBP. In addition to that 30% extra deduction we are giving you, indirectly we are promoting you to give employment opportunities. So we are incentivizing the entrepreneurs so that they can give employment to people, so they can claim benefit under 80JJAA for additional employees that they are recruiting. Suppose you started newly business in this year only. Last year also you don't have any business. This year, this is the first year. In this year, how many ever you newly recruited? No, all of them are treated as additional employee. Salary paid to them is treated as additional employee cost. Multiplied by 30%, you can claim deduction under 80JJAA. Understood? Now, the following are not treated as additional employees. The following people are not treated as additional employee. Suppose if the total emoluments means nothing but monetary benefit given to employees except provident fund, except pension fund, except lump sum amounts. Any amount paid, allowance, basic, DA, bonus, commission, whatever, monetary emoluments paid, if it is exceeding 25,000, this fellow, the people who are earning more than 25,000 rupees monetary, they cannot be considered. They will not be considered under additional employee definition. They are not considered. And employees for whom entire contribution to provident fund, pension fund is paid by government, means government supported employees, they are not counted as additional employees if you recruit them. Nothing but part-time employees, those who are working in government, here also maybe similar to that situation it can come. Third one, so government employees and all, they don't come under additional employee. Third one, if an employee who is not participating in provident fund, so you have an employee, you recently recruited some 30-40 employees, they are not working in provident fund, they are not choosing provident fund, they are not contributing to provident fund, they are not participating at all, he will not be counted as additional employee. He will not be counted as additional employee. Or an employee who is employed for less than 240 days. Less than 240 days means what? Employed means not attendance. Many think it is attendance. It's not attendance. Suppose I recruited an employee on 1st April. Up to 31st March, he is working in this company. Maybe he is absent for 200 days. Absent is not matter. Is he an employee of this organization? Yes. For how many days? Entire 365 days he is employee. Less employed for 240 days. Less than 240 means for how many number of days he is an employee in your organization. That is what important. If an employee is employed for less than 240 days in this year, he is not considered as additional employee. But the same person, next year he is there full year. Now next year he is there for more than 240 days, more than or equal to 240. For that year, he will be treated as additional employee for that year. From that year, 30% of additional employee cost, whatever you are paying to him, you can claim deduction for 3 years. Able to understand. Now we will solve a question on this. So we will solve an illustration directly, which we solved in our class. So you will understand better. Now you see here. Now further no. Now who are all not coming under additional employee? If an employee whose total salary amount is exceeding 25, he is not additional employee. Who is not participating in RPF, he is not additional employee. For whom entire contribution to pension or provident fund is paid by government, he is not additional employee. Who is employed for less than 240 days in that organization, he is not additional employee. Suppose if it is a footwear, apparel, leather business, no. Then instead of 240, 150 days is the criteria. Fine. Now, so you see here, only this is the one problem which I am doing here. Now, anyhow, we have, after this, you have test your knowledge questions also. Some 5 questions on chapter 6 I solved. That also you see. Mr. A commenced the business of manufacture of computers on 1st April. So, newly started business. So, newly started business means one condition we need not check. Last year, how many were there? This year, how many were there? Overall increase there or not? That and all you need not check. Because there's a newly started. So, how many ever he recruited during this year? All of them comes under additional employee. He employed 350 new people during this year. Oh, very good. The details are. On 1st April, 75 staff were recruited and we are paying 24,000 rupees salary, monthly emoluments, and they are regular employee. And they are here somebody is casual. Now let us see. Regular employees participate in RPF, very good. Whereas casual do not. Okay. So casual employees, no, they are not participating in RPF. So will they come under additional employee definition? No. Now here, second category, 125 employees we recruited on 1st May 2022. Let us assume all these people were continued up to 31st March 2023. They are all continued. They didn't resign in between. Now that means employees who were recruited on 1st April, they continued up to 31st March 365, more than 240 days. Therefore, this is additional employee. Next, second, 125 employees we recruited on 1st May. 335 days they are there in the organization. But their emoluments is more than 25. So they are not additional employee. Now 50 employees, 1st August, exactly 244 days it will come. 1st August to 31st March, 244 days it will come. But they are not participating in RPF. RPF they are not participating. Therefore, they are not additional employees. Then finally, 100 employees. 1st September I recruited, up to 31st March were there. Amount paid to them is less than 25. They are technically speaking additional. But I recruited them on 1st September to 31st March, less than 240 days. Since they were employed for less than 240 days, for 22-23 previous year, they are not treated as additional employee. Suppose if these 100 people continue in the next year also, they are treated as additional employee for the next year. For the next year, they are treated as additional employee. So, since they are employed for less than 240 days, they are not additional employee. Understood or not? Check out 4th August or after. On or after 4th August, if at all anybody is recruited by the organization, they are working for less than 240 days. Check out calculator. 4th August to 31st March. Check the date. Since here 1st August, more than 240. They are additional employee. But since they don't participate in RPF, we do not consider them as additional. Now tell me, how much reduction? Whatever salary paid to additional employee, here additional employee only this first category comes. How much salary we are paying? We are paying monthly 24,000 rupees. For how many months? They are recruited on April 1st. So 12 months we are paying. How many employees? 75 employees. So 24,000 into 12 months into 75. So we are paying 2 crore 16 lakhs. Very good. Now, this entire 2 crore 16 lakhs PGBP deduction they will claim. For all these 350 employees, whatever salary paid, PGBP they will claim deduction under 37. That and all is fine. In addition to that, 30%. How much is 30%? Into 30%. 64 lakh, 80,000 is deduction under 80 JJAA. Now, to these 75 people, next year also they pay salary. Na? On that salary again 30%. Third year also they pay salary. Na? On that they will get 30%. 3 years they'll get. Whereas this category is there in 100. For this year, they are not additional employee. But for the next year, if they are employed for more than 240, they are additional. Whatever salary paid in the next year, into 30. That next year, total 3 years. 30%, they'll get deduction under 80 JJAA. This is the answer. Now here, they have asked another question. What would be your answer? If Mr. A commenced business of manufacture of footwear on 1st April, suppose here he started computers now, then 240 days. Footwear business means for wearing apparel, footwear, leather products, less than 150 days only he is not counted. 150 days or more than 150 days, if the person is employed, he is counted, which means second alternative answer, salary paid to these people will also come under additional employee cost because they're employed for more than 140 days, more than 150. So 1st September onwards, 100 employees were paid, monthly 24,000 were paid. 1st September means 7 months we paid salary. So 24,000 into 100 into 7 months is equal to 1 crore 68 lakh. Getting it? Into 30%, that is a deduction. Yes or no? Is equal to 50 lakh 40,000. So total deduction is what? So for category 1, 75 employees, for category 4, 100 employees. So plus 64. So how much it is? 11 lakh 1 crore 15 lakh 20,000 is a total deduction. Alternative answer, second part of the answer. So now let's see. For the first part of the answer, the deduction is 64 lakh 80. Second part of the answer, it is by mistake given in the next page, that next page. Yeah, that next page, you see here. So how much is the answer? 1 crore 15 lakh 20,000. That's it. This is the answer for 80 JJA. This is how you have to compute. There is a possibility in the exam for November 2023, this question, even if it is May 24 also, they may ask, who knows. That's it. With this, we have completed the entire chapter 6 deductions within 1.5 hours. Now I have given another half an hour continuation. Solutions are also there. So solving these problems, and already I explained, everywhere I took monetary amounts and explained. Indirectly we solved many problems already while we are discussing all the provisions. So 2 hours we took entire chapter 6 entire each and every section, entire theme, entire points are covered. Only thing which I did not do is reading each and every line and explaining you in depth. That we didn't do. In a regular class for us it is 8 to 9 hours chapter. Getting it? In a revision class it is only 2 hours. That's it. Okay, have a nice time. I hope you enjoyed chapter 6 introduction. Getting it? That's it. So let's continue. Test your knowledge questions in chapter 6A. So I hope you did proper revision of all the provisions of chapter 6A. Getting it? Then only you start listening to this. Then only you solve test your knowledge, because these are all comprehensive. These are all comprehensive questions. Like, fine. So let's see what are they. So examine the following statements with respect to the provisions of income tax. So they are asking you, they have given certain statements, so you need to examine those statements. If the statement is correct, you will say that it is correct. Otherwise, you will say it is incorrect. During the financial year 22-23, Mr. Amit, he paid interest on loan availed by him for his son's higher education. Okay, so he has paid an interest on loan. His son is already employed in a firm. Mr. Amit will get deduction under 80E. I think under 80E, there is no such condition called dependent. Getting it? Therefore, he can claim deduction. So the statement is correct. Getting it? So there is no condition under 80E that children must be dependent. Self, spouse and children. For these three, higher education loan can be taken, interest can be paid, and that can be claimed as deduction under 80E. And even in respect of a person for whom the individual is a legal guardian. So for his also he can take a loan for education, interest is eligible for deduction. Next, subscription to notified bonds of NABARD would qualify for deduction under 80C. Yes, subscription to notified bonds of NABARD is eligible for deduction under 80C. Eligible issues, yes or no? So under 80C, subscription to bonds issued by NABARD as central government would qualify for deduction under 80C. In order to be eligible to claim deduction under 80C, investment contribution subscription in eligible or approved modes should be made out of income chargeable to tax. They are saying you should only, in order to claim deduction under 80C, you should contribute out of income chargeable to tax. They are saying there is no such condition in 80C. In 80C, if you contribute, you will get deduction. So from which funds? Say you might have so many funds. You might receive agricultural income, you might receive capital gains, you might receive house property, you might receive salary income, all that. So you may be having incomes from various sources. From which income you took the money and invested in 80C? That is not relevant. Only in 80CCC, if you recollect, contribution to LIC pension fund out of income chargeable to tax. That's what is given only in 80CCC, not anywhere else. So here the statement is not correct, because in 80C there is no such condition that the donation, the contribution, getting it need not be out of income. So there is no stipulation under 80C that investment subscription should be made out of chargeable income only. See, this point in reality nobody will see, okay, because very difficult to prove. Next, where an individual repay a sum of 30,000 rupees towards principal and 14,000 rupees as interest in respect of loan taken from a bank for pursuing higher studies, the deduction under 80E is 44,000. Yes, here for whose purpose higher studies loan he has taken, that point is not given. Let us assume that is for individual self. So he for himself, okay, principal is 30, interest is 14. We only get interest, which is only 14,000. Under 80E, we only get interest on education loan. We don't get entire principal. So the answer, the statement, what they are saying, entire 44 he is eligible for deduction. That's wrong. Only 44. So the statement is not correct. Fine. Next, Mrs. Sheila, widow of Mr. Satish, who was an employee in XYZ Limited. Okay. So Sheila is a widow of Satish, who is an employee in XYZ. Received 7 lakh rupee on 1st May 2022, means 22-23, being amount standing to the credit of Mr. Satish in his NPS account. NPS means what? Immediately National Pension System, National Pension Scheme, Central Government, pension scheme, Atal Pension Yojana. So there is a person called Satish. In his account, in his NPS account, there is an outstanding balance of 7 lakhs. Because Satish died, his legal heir, his nominee, she received the 7 lakh rupee. You remember 80CCD, withdrawal from National Pension System. Okay, fully if you close the account and withdraw, 60% exempt, 40% taxable. And if you withdraw partially, 25% of contribution made by you is exempt. Here, the amount is withdrawn on account of death of the person. If an amount is received on death of the person, entirely it is exempted. So where deduction is allowed under 80CCD to Satish in the earlier previous year, such amount received by her as a nominee on closure of the account is deemed to be income. It's incorrect. It's not correct. Okay. So 80CCD provides that amount received by nominee on death of the SSE shall not be deemed to be income. Suppose if Satish only received when he is alive, he only closed the account, fully taxable. While taxing, 10 clause 12A, 60% is exempt, 40% is taxable on full withdrawal, full closure. If you partially withdraw from National Pension System account, 25% of the contributions made until then, that is exempted, rest 75 is taxable. Mr. Vishal, a central government employee, contributed 50,000 towards Tier 2 account of NPS. The same is eligible for 80CCD. Wrong. If you are contributing to Tier 2 account, that is 80C. In National Pension System, Tier 1, Tier 2 is there. Entire Tier 1, whatever contributions you are making to Tier 1 of National Pension Scheme, that is eligible for 80CCD, subsection 1, 1B, subsection 2, remember. Whereas whatever amount you are paying to additional account under NPS, that is Tier 2 account, that is eligible under 80C only. So, National Pension System, Tier 1, Tier 2. Tier 2 contribution 80C only, Tier 1 only we have a separate section called 80CCD. So, here they are saying Tier 2 80CCD. That's wrong. Tier 2 contribution is 80C deduction. So, the statement is not correct. Getting it? Tier 2 contribution to NPS is 80C and not 80CCD. That's it. Next. Examine the allowability of the following. So whether the following items are allowed or not, they are asking. Rajan has to pay to hospital for treatment of 62,000 rupees and spent nothing for life insurance of maintenance of dependent disabled. Now you see, there is a person called, he is a dependent and disabled. Getting it? For maintenance of dependent with disability. So some dependent is there on him, he is disabled. Now dependent relation is not given. Now tell me, in 80, we have a point. See, when the SSE is having a dependent with disability, the SSE can claim deduction under 80DD, right? If it is normal disability, flat 75,000. If it is severe disability, flat 1,25,000 deduction, correct? Now, dependent means who? Spouse, children, brother or sister, parents who are mainly and wholly dependent on this SSE. Now here, dependent, they said, relationship they have not given. Let us assume he is within the definition of dependent given in the 80DD. This dependent is covered in 80DD. Let us assume that. So if you take that assumption, Rajan is maintaining the dependent, no? How much he spent? 62. So how much deduction he'll get? 62. No. Actually, how much you are spending is irrelevant. Remember, it is disability. Disability means 80DD. Suppose here they used the word not disabled. They used the word dependent suffering from specified disease. If they use the word disease, then the provision is 80DDB. Are you getting the point? So disability. So how much you actually spend doesn't matter. Flat 75,000 he will get deduction. So in this case 75,000 rupees under 80DD is allowed as deduction flat, irrespective of actual expenditure incurred. Yes or no? You see, when I'm explaining, I'm recollecting the entire provision that we discussed. In exam, no, you just have to write simple answer. Normal disability flat 75, severe disability 125 under 80DD, irrespective of expenditure. But I'm recollecting the entire provision because when you are reading MCQs, when you're reading true or false questions, this is how you should learn. You should not only see that question and answer relevant point. You should recollect the entire provision. That's how you can develop your command on the MCQs, command on the subject. Next, Raja. He is a resident in India, okay, resident Indian. He has spent nothing for treatment in the previous year, okay. He didn't spend any single rupee, okay, and deposited 25,000 with LIC for maintenance of dependent disabled, okay. So again here, some dependent is there who is disabled on Mr. Raja. So he has spent zero, nothing he spent, zero. Still, Raja will get flat deduction of 75,000 for normal disability, flat deduction of 1,25,000 for severe disability. That's it. So you see, the Rajan has deposited 25, doesn't matter. So the SSC is eligible to claim 75,000 since deduction of 75 is allowed irrespective of amount deposited with LIC. In case of severe disability, 1,25,000, same. So this entire question is on 80DD only, completely. Okay, nice. Next, Rajan has incurred 20,000 for treatment and 25,000 was deposited with LIC for maintenance of dependent disabled. How much you incurred, how much you deposited, that and all doesn't matter. Is there a dependent? Yes. Is he disabled? Yes. Flat 75,000. Normal disability. Severe disability flat 1,25,000. This question is completely 80DD, almost all the 3 points. Fine, next. Payment of 50,000 rupees by check to an electoral trust by Indian company. Remember, to a political party and electoral trust, you must contribute only by other than cash. If you even single rupee also in cash mode is not permitted. So 80GGB. Since the donation is made by Indian company, suppose if the donation is made to political party by foreign company, 80GGB deduction you will not get. Suppose in exam if they mention foreign company, you will not get deduction at all. I hope you're clear. So 80GGB. Suppose if the donation is by not Indian company, some partnership firm, LLP, individual, HUF, they contributed, then 80GGC section will come into picture. Now some students might have a query here. Sir, do we need to quote section numbers in all these kinds of cases? Generally, these questions will not come directly. These questions will be tested in the form of MCQ, where you just have to select the option. Suppose in exam, in the descriptive paper, true or false question is asked, if at all. In such a case, yes, you are supposed to quote section number, only then you will get full marks. Getting the point? In income tax and GST, taxation paper and law paper, section numbers are expected by the institute. Getting it? That shows your proficiency in the subject. That's what they believe in. So this is eligible for deduction under 80GGB. That's it. Next, question number 3. For assessment year 23-24, gross total income of Chaturvedi, a resident in India, he is a resident, was 8,18,240. So for Chaturvedi, who is a resident, the gross total income is 8,18,240, which includes, important observation, long-term capital gain of 2,45,000 taxable under 112 and short-term capital gain 58. Remember, short-term capital gain is not 111A. This is normal short-term capital gain. This is eligible for chapter 6A deductions. Yes or no? If 111A gain they specifically mentioned, no, that is not eligible. Now let us look at what is the gross total income. What is the gross total income? 8,18,240. In this, what is the income taxable at special rates? Special rates 2,45,000. LTCG of 2,45,000 is only taxable at special rates. So what is the balancing figure? Which income is taxable at normal rates? So balancing figure is 8,18,240 minus 2,45,000 is equal to 5,75,240. Sorry, 73. 5,73,240. This is normal rates. Now you know you need to immediately recollect. The total chapter 6A deductions cannot exceed. It cannot exceed this amount. Correct? Because this is only treated as gross total income from the point of view of chapter 6A deduction. Yes, next. Now the gross total income includes interest income of 12,000 with savings bank deposit with a bank. Oh, and 40,000 rupees interest on FD. So savings deposit of 12,000. So within this income 12,000 is savings bank interest and some 40,000 is FD related interest. Just I'm writing the observation here. So there is no relevance for this. Just I'm writing it. Now let us see what is the age of Mr. Chaturvedi. You know, if age of Chaturvedi is less than 60, 80 TTA section is applicable. Up to 10,000 savings interest is deductible. Suppose if the age of Chaturvedi is more than or equal to 60, if he is a senior citizen and resident in India, then 80 TTB up to 50,000 interest deduction can be claimed. Now they have given information regarding age somewhere. You see here? Yeah. So compute the total income and tax thereon. Sorry. Compute the total income tax thereon of Mr. Chaturvedi, who is 70 years old. Okay. As on the date, as on 31st March, he already 70. Means already crossed 60. Which means he is a senior citizen. Therefore, 80 TTB up to 50,000 can be claimed because total interest is how much? 52K. But you can claim deduction for interest income for a senior citizen, whether it is fixed deposit interest or savings interest, you can claim up to how much? 50,000. So minus 80 TTB, I am claiming here 50,000. Okay, next further. Chaturvedi has invested in PPF 1,20,000. Okay, this is ATC. Minus ATC. How much? PPF 1,20,000. Let us see. Is there any other ATC also? We will see. And also paid medical insurance premium of 51,000. For whom he paid? For himself only he paid. Nothing is given. He is a senior citizen. Remember, for a senior citizen, medical premium for each category is how much? 50,000. So minus 80D. How much it is? 50,000 straight away. Suppose if Chaturvedi, he is having parents also who are also alive. For them also he has paid medical premium. Then another 50 he will get. Suppose for parents medical policy is not there, but he is incurring medical expenditure. Up to 50 he can claim. But if at all that information is given only, we will consider. Otherwise we will not. Fine, next. Finally, Mr. Chaturvedi contributed 50,000 to public charitable trust eligible for deduction under ADG. Remember, contribution to public charitable trust. How he contributed? By account payee check. So obviously more than 2,000 rupees in ATG you must pay by other than cash. He paid in other than cash only. How much he paid? 50,000. This is contributed to charitable trust, which comes under category 4 of ATG. Whenever the moment category 3, category 4 comes now, what we should check? Adjusted total income we should check. What is adjusted total income? Gross total income minus long-term capital gain minus short-term capital gain 1 year and minus exempted income. So all that you see. Then from that, other deductions 80 TTB we reduce. So total ATC 1,20,000 we reduce and 80D we reduced. Now 80G shall I reduce? No. For calculating adjusted total income, don't reduce 80G because you are calculating adjusted total income for the purpose of 80G. So don't reduce 80G deduction. So now what is this effect? Just count it. So what is adjusted total income? Let us see. 5,73,240. So below we will see. So how to compute adjusted total income is equal to, so gross total income normal rates how much? 5,73,240 minus ATC, 80 TTB plus 80D. In these three sections were there. Put together how much is the total deduction? 50,000 plus 1,20,000 plus 50. So 2,20,000. So how much it is? 2,20,000. 2,20,000. Now if you reduce that, 3,53,240. Correct? Huh? So just a minute. Plus 573,240. Yeah. 353,240 is adjusted total income. Now on this 10% is how much? 35,324. This is the adjusted total income 10%. Now category 4 Category 4, how much we paid? 50. Now category 3 plus category 4, amount paid, no, it shall not exceed, amount paid shall not exceed this amount, na. So I will restrict this 50,000 to 35,324. Since it is category 4, 50% reduction. Yes or no? Into 50 is equal to 17,662. Under ATG, the answer is 17,662. For this, you need to write working note 1 in exam. So this working note you should give in exam. Anyhow, the answer is given in there also. You can follow that presentation. That is enough. I hope you understood how I did entire this calculation. Getting it? Now let's compute what is the balance total income. So 5,73,240 minus 50,000 minus 1,20,000 minus 50,000 minus 17,662 is equal to 3,35,578. This is the total income excluding long-term capital gain. Now what is the total income? This amount plus 2,45,000. This amount, what is this amount? 3,35,000 plus 245 is equal to total income is equal to 5,80,578. Yes or no? I hope you are computing. Next. Now compute tax on this. Again, while computing tax on this, we should split into two. Special rates. I hope you recollect the process which we followed in first chapter. We always split the total income into two parts. LTCG how much? 2,45,000. So normal income so how much? 5,80,578 minus what is the basic exemption limit? Now you see within this 5,80,000, no, up to 5 lakhs. Up to 5 lakhs one category, because the tax rate after 3 lakhs up to 5 lakhs. Up to 5 lakhs, no, if the first slab 3 lakhs is exempted. So 2 lakhs. Remember his age is not 80 man, his age is 70. So he's a senior citizen. Into 5% is equal to 10,000. Now balance 80,578 into 20%. How much it is? 80,578 multiplied by 20. 16,115. On this 20% long-term capital gains tax into 20. 49,000. So what is the total tax liability? What is the total tax liability? So 49, 16,115 plus 10,000. 75,115 plus 4% cess. So 78,120 is the final tax amount. So because they are asking tax also they are asking. So total income is 5,80,578, nothing but 5,80,580. Nearest to 10 rupees you can round off. So let's look at the answer. If this question comes in exam, minimum 6 marks to 8 marks. That's it. 5,80,580. Tax liability, what? Did we compute it wrongly? Just a minute. Sorry, I'm sorry. I did wrong computation here. A balanced total income is not this one, no. This one, no, we computed rightly, but we took wrong amount. That's it. 3,35,000. How much? 578. If at all, any of you did rightly, ignore it. If at all, I just confused you, ignore it, because I just took wrong amount. Sorry, by mistake. So, whereas long-term capital gain, that amount is correct only, ma. That amount is correct only, 49,000. Whereas in this, no, 3 lakhs is exempted. 35,578 multiplied by 5%, ma. 35,578 multiplied by 5%. How much it is? 1778. Both put together, 50,778 plus 4% is equal to 52,810 rupees. By the way, here rebate he will not get. Why? Because the total income is exceeding 5 lakhs. So there is no question of rebate. Rebate when you will get, if the total income is less than or equal to 5 lakhs, you can claim a rebate up to 12,500. That's it. 52,810. That's correct answer only. Yeah, that's correct answer only. Here, no, while allocating, by mistake I have allocated like this. Fine. Anyhow, that's it. I hope you understood the theme. That's enough. Next. Question number 4. Question number 4. Mr. Raj Mohan, whose gross total income was 6,40,000 for the financial year 22-23, furnishes you the following information. Is there any other income given? No, that itself is gross total income. So entire gross total income is eligible for chapter 6. Why? Because there is no special income. 6,40,000. Stamp duty paid on acquisition of residential house, self-occupied property, minus that is eligible for ATC man. You know, right? 50,000. Okay. Next, 5-year post office time deposit. That is also ATC. How much it is? 20,000. 20,000. Already ATC 70,000 limit claimed. Check out. Be careful. Donation to recognized charitable trust. ATG we will see later. Interest on loan taken for higher education paid how much? ATE. 10,000 he paid. How much he paid? 10,000 he paid. Now ATG. Donation to a charitable trust of 25, which is eligible for deduction. Okay. So charitable trust donation, how much he paid? 25. Now let's compute adjusted total income, because donation to charitable trust comes under category 4 of ATG. So adjusted total income is equal to 6,40,000 minus all deductions under chapter 6A except ATG. So 6,40,000 minus 50 minus 20 minus 10. So the answer is adjusted total income is 5,60,000 multiplied by 10% is equal to 56,000. The total donations under category 3, category 4 paid shall not exceed this amount. But here he has paid only category 4, that to 25,000. It is less than this. So entire 25,000 paid to the charitable institution will qualify for deduction. Now this is qualified now. Now how much is the deduction? 50%. So 12,500. That's it. So 12,500. So what is the total income? 5,47,500. That's it. So compute total income, Mr. Rajamohan. That's it. So 5,47,500. So we also computed the same, 547,500. I hope this is a very easy question. Very easy question. Next, question number 5. Compute eligible deduction under chapter 6A for assessment year 23-24 of Miss Roma. You see here what they are asking is you just have to compute deductions under chapter 6A. Sometimes no students by mistake compute, since they gave gross total income, they compute total income answer. Please observe what exactly they are asking. Are they asking you to compute gross total income? Are they asking you to compute total income? Are they asking you to compute only chapter 6A deduction? Please observe carefully. Sometimes they will ask you total income plus tax liability. So we have seen question number 3. Whereas in question number 4, they just ask for total income. Whereas in question number 5, only 6A deductions total they are asking. Be careful. Getting it? And remember, total 6A deduction cannot exceed gross total income. That also you should keep in mind. Fine. His age is 40 years. Who has a gross total income of 15 lakh? So he is having a 15 lakh gross total income and provides the following information. Is there any special incomes? Nothing. So total chapter 6A cannot exceed 15 lakhs, because 15 lakhs is what? Gross total income. Correct? Next. Life insurance premium paid, policy taken on 31st March. Whatever the date it is, I should classify it as before 1/4/2012. If insurance is taken before 1/4/2012, up to 20% of sum issued. If the insurance is taken on or after 1/4/2012, up to 10%. So 35,000 na amount paid. Sum issued is 4,40,000 into 20%. Up to 88,000 you can claim, but he paid only 35. So entire 35,000 is eligible. Yes or no? PPF contribution 1,50,000. So 1,50,000 also comes under ATC. This is ATC. This is ATC. Repayment of housing loan to Bharatiya Mahila Bank, Bangalore. This is also ATC, 20,000 ATC. Remember, ATC has a total limit of 150. That we will see later. Contribution to pension fund. Okay. Total of ATC is over. So total ATC deductions, how much he paid? So 205 he paid, but restricted to 1,50,000. ATC is restricted to 1,50,000. Now this amount, ATCCC, how much he paid? 1,40,000 he paid, pension fund. Now we know that ATC, ATCCC, ATCCD subsection 1, donation to pension fund by the SSE. These three amounts shall be restricted to again 1,50,000 as per ATCCE. So these two amounts ultimately shall be restricted to ATCCE, which is again 1,50,000. So that's it. So until this box, getting it? What is the amount of deduction available? 1,50,000 only. Next. And this fellow has taken medical policy for self, wife and dependent children. Premium paid. So in Mediclaim, remember ATD, children must be dependent. Only then you will get deduction. Yes or no? In ATC, children can be dependent or non-dependent. Doesn't matter. Getting it? 30,000 they paid. But remember, this fellow age is 40 years. Therefore, for that fellow category, for him, spouse and children put together, maximum deduction is how much? Maximum deduction is 25,000 only. Whereas Premium paid for fathers by check, both are check only, so no problem. Senior citizens. So for another category also they paid premium 52, but maximum deduction is what? 50. So total deduction under 80D is equal to what? 80D 75,000. So 80D 75, 80C plus 80CCE restriction applied 1,50,000. Total 2,25,000 is the answer. That's it. So with this, the chapter 6 year deductions related problems we have completed already while we are listening our regular classes main. In that we have solved almost 18 illustrations. These are just additional test your knowledge questions which are given at the study material ICI at the end of each and every chapter. So that also we have solved. Getting it? So that's it. So generally test your knowledge questions, no, I will be uploading in the YouTube while I'm uploading marathon related to these classes. That's it. Okay. So take care. With this chapter, deduction chapter is completely done. So 5 plus already 18, 23 problems we solved in the classroom while we are discussing chapter 6 deductions. Getting it? Already all these adjustments we have already seen in the classroom itself while we are doing illustrations. Getting it? That's it. Take care.